Yes, Penny, we hear you.
Great. Okay. Well, welcome, um, distinguished guests, ladies and gentlemen. Good morning and welcome to today's session. Let me first introduce myself. I'm Benny Arekelian, and I am one of the 24 partners of the FinTech project, which started in 2019. And we are very happy to have you with us, and we hope to have an interesting discussion after the presentations. I'm very happy and honored to have with me to open today's session Rapolas Lakavicius, who is the policy officer, who is a policy officer at the DG Connect of European Commission. His primary responsibilities were mainly focused towards blockchain standardization. And previously, he worked with European Research Framework Project and broadband internet policies. Rapolas, thank you very much, and thank you for advising us and for being so close to our project. And we hope in the future to have more projects to manage with you. The floor is yours.
Thank you, Benny. Very nice introduction. And I would like to say that it's an honor for me to act as project officer for FinTech project, which is a part of a broader strategy of the European Commission to promote digitization in FinTech and subtech sectors. Basically, in the European Commission, probably most of you know, we have quite a few activities in this area. We have a collaboration with INADBA, International Association of Trusted Blockchain Applications. We have European Blockchain Partnership, which involves all member states and additional European Economic Area countries, which is developing European blockchain services infrastructure. We have a number of Horizon 2020 projects. Last time we were looking, we have approximately more than 300 currently, various Horizon 2020 projects which are working in one way or the other in the area of blockchain. We have a blockchain observatory, which is bringing in international experience, and we have standardization activities where I work quite a bit, and we have a rolling plan for ICT standardization in place, and of course a number of legislative activities, legislative actions, of which probably the most important currently is the regulation for markets in crypto assets, so-called MiCA regulation, and likely that in the future we will have a move of the internet towards so-called the internet of value, which thanks to blockchain, big data, AI, and other technologies likely will change quite a bit the way we live and the way we operate. And in particular, fintech and subtech sectors will likely have quite a tremendous and humongous change taking place. Thus, developing competence and bringing people together, bringing all actors, stakeholders from all the member states and beyond the European Union is very, very important. And this is why we have FinTech project, and this is why we very much welcome this International Conference of Economic and FinTech. So thank you.
Thank you, Rapolas. Thank you very much. Thank you. I guess we can wait just for 2 minutes for some other participants, and then we welcome our first keynote speaker. Well, let's proceed. Our next speaker is Professor Dirk Niepelt. It's a great pleasure and honor to welcome Professor Dirk Niepelt to the first International Conference on Economics and FinTech. Professor Niepelt is director at the Study Center of Gerzensi, professor at the University of Bern, president of the Swiss Society of Economics and Statistics, research fellow at the Center of Economic Policy Research, member of the macroeconomic committee of the Brain for Socialpolitik. His research interests are macroeconomics, international economics, and public finance. He has published his work on top rated journals like Economic Journal, Journal of Monetary Economics, European Economic Review, Quarterly Journal of Economics, Review of Economic Dynamics. Also, his work on CBDCs is acknowledged by other distinguished economists like John Cohen in his blog. And I would like to say a few words from my personal experience and interaction with Professor Niepelt. It was about 1 year ago. And the way he acts and his manners are in one-to-one correspondence with his status, a well-distinguished scientist and top economist. He never neglected to reply to any of my emails. He stood by me and by this project when we had to cancel the conference. He was there when we rescheduled it 2 times, but due to Corona outbreak, we didn't even have the chance to announce it. And now he says at this virtual version of the conference, he is committed without even need to book any flights. I want to thank him from my heart, and I will use an expression, τα πάντα ρί και μηδέποτε κατά αυτό μένει, meaning that everything changes, nothing stalls. Professor Niepelt, thank you again for having you here and hope to welcome you next year in Athens.
Well, thank you very much, Veni. This is very, very nice. Thanks very much for the introduction. My Greek is pretty rusty. I used to have ancient Greek in school, so I know the first couple of lines of the Odyssey, but I didn't really understand what you said. So Yassas, I remember that one. Good. So it's a pleasure with you, to be with you. Let me try to share this. Yes. You need to allow me, I think, to share the screen, right?
Yes.
Let me try to get this right. Yeah. So if you're lucky, then you should see my slides now.
We do.
And it moves. They move actually.
Yes.
Perfect. Okay. So I have 30 minutes, and we're a relatively small group. So just interrupt me at any time, and let's make this very informal. I'm very happy to be with you in Athens, sort of virtually, and I want to talk a little bit about macroeconomic aspects of central bank digital currency. I understand that many of you have a bit of a technical, or maybe more of a technical perspective on how to implement these things, blockchain, fintech applications. Here I want to be really, I really want to take a bird's view, a macroeconomic perspective on the question. Because what happens when you talk in particular to central bankers and to bankers about central bank digital currency is typically that you hear fears about, you know, this is dangerous, this could disintermediate banks, this could give rise to more bank run risks, and all of this is, you know, not good. So let's be careful with introducing CBDCs. And I'm trying to, you know, put some light on these issues, try to clarify some of these issues as much as I can. And I want to report a little bit about some ongoing research in that respect. So what I'm talking about now in the next couple of minutes, and again, please interrupt me at any time, is stuff related to a recent paper of mine, which you see here on the slide. And if you're interested, feel free to download the CPR working paper. There's also a column on Bex EU a couple of weeks or so ago in which I summarize some of the findings in that paper. So what I do in the paper is to really, what I think, look at the core macroeconomic question that we are thinking about when we think about retail central bank digital currency. And the macroeconomic question is not, you know, should this be on a blockchain, or should it be on some prepaid card, or should it be an account-based system, etc. The macroeconomic issue really is, are we going to move away from the current monetary system, which is a two-tiered monetary system? We bank with some banks, and then the banks among each other, they interact with a central bank with a different type of money, as you know, with reserves, central bank money, while we with the banks mostly interact in the form of deposits, which is, you know, privately created money and not central bank money. So what I'm interested in is really to understand what is the difference between the current world in which we have this two-tiered monetary system on the one hand, and then this polar extreme, which is a CBDC-based world, a world in which, in some sense, you have a single tier only. Everybody is directly banking with the central bank as far as means of payments are concerned. And in previous work, I dubbed that reserves for all, in the sense that it's not only the commercial banks that would hold reserves at the central bank, but it's also the private sector more broadly that would be able to hold reserves at the central bank. And in the paper, I study the consequences of this from various dimensions, various perspectives. Some of the questions are, the main question maybe is, what is the optimal monetary system? If you have the choice between these two, the two-tiered on the one hand and the CBDC on the other hand, what is the optimal monetary policy in either of the two or combinations of the two? What is the effect of introducing CBDC in the current world? Does it really change everything as many people are afraid of, or maybe not that much of a big deal? And as a side product of that, there's also some implications or something that we can learn about how big bank profits in the current system are because of the ability of banks to create money, or because of the fact that we are actually using bank money as a means of payment. These are some of the implications. And what I want to do in the next 20 minutes is I want to focus on the last 2 points. So I want to clarify in a very simple fashion, without going into formalism or details of the model. I want to understand and talk a little bit about what the macro effects are of introducing retail CBDC in the current monetary system, and how banks profit from the current system, and how this could change in a world with retail CBDC. So let me focus on these two points, and let me try to clarify them by looking at very elementary aspects of the argument, which nevertheless carry 90 or 95% of the story, I think. So let me do this by looking at a balance sheet first, or two balance sheets first. What you have on the left-hand side here is the balance sheet of the central bank. Of course, super simplified. There are some assets on the asset side, maybe government bonds, maybe gold, whatever the assets of the central bank are. And on the right-hand side, there are the liabilities of the central bank, which here in that simple framework are simply reserves. In reality, you would also have some cash, you would have some equity, etc. But let's look just at the elements which are relevant for the argument. On the other side, on the right-hand side, you have the balance sheet of a typical bank, Piraeus Bank, say. So they have some liabilities. Here again, I focus only on the one that I care about, deposits. And on their asset side are the reserves, so the exposure of the commercial bank vis-à-vis the central bank, and some loans that the commercial bank has extended to Main Street. Now, in terms of the variables I'm going to use for the argument, so that's all the notation that you will see, so don't be worried. So I will call these the assets of the central bank, the reserves of the central bank, the deposits of the commercial bank, the reserve holdings of the commercial bank, which are equal to that one, and the loans of the commercial bank. And what I have introduced here is basically some zeta. The zeta denotes the ratio of reserve holdings relative to deposits, so the degree to which the deposits are backed by reserves that the commercial bank holds at the central bank. Commercial banks typically hold some reserves at the central bank because this makes it easier for them to conduct business amongst each other, with each other. So that's the world that we live in right now. That's this two-tiered monetary system. The households, so the private sector, they bank with this commercial bank here. They use deposits for their payments. And the banks among each other, they use reserves to make payments between the banks. And these reserves are liabilities of the central bank. So now let's introduce retail CBDC. What is it that would change in this simple balance sheet? So what would happen is presumably that some of us would go to the bank, to Piraeus Bank, and would say, you know, I used to have deposits at you in some account with you, and now I want to withdraw some of these deposits from my account with you, and I instead want to invest them in CBDC. So in the balance sheet, you see this here. There's some delta. That's sort of that's the outflow of the deposit account. That's the amount of deposits that the households want to withdraw from their deposit account, and instead they hold this now with the central bank. This is the new central bank account, so to speak, of the households. Now, what will happen as well is, of course, if many of us withdraw money from our deposit account, then the commercial bank will also reduce their reserve holdings because they want to maintain the ratio zeta. So therefore, since they have now fewer deposit liabilities, they will also have fewer reserve assets as a consequence of that. So the R prime here in the central bank's balance sheet will have changed. There will be less reserves of the central bank outstanding, but at the same time, there will be new liabilities, CBDC, outstanding at the central bank's balance sheet. Now here you see on the right-hand side in red, what makes many people worried, right? Because if you just think about what has happened now to the commercial bank, they have lost funding delta. They also invest a little bit less in reserves, but still on net, they have lost delta times 1 minus zeta in their funding. So you might say, well, there's now a hole in the balance sheet of the banking sector, and maybe now these guys have to reduce their loan exposure, et cetera, and this is maybe problematic. Now, why is this a half-baked argument? If you hear that, you should be skeptical. Why is this? Because we haven't thought about what is happening at the central bank. The central bank has more funding now, delta. It has a little bit less here, but it has more from that source. So on net, the central bank has gained funding delta minus whatever it has lost due to the reduced reserve holdings of commercial banks. So what I put here with these red dots means that since the central bank has additional funding relative to the situation we had here, the central bank also needs to invest somewhere, right? That's an accounting identity. If you have more on your liability side, then you also need to have more stuff on your asset side. So the question is, where is the central bank going to invest that additional funding that it has gained due to the issuance of CBDC? And one sort of obvious answer is, well, you know, since this number here is exactly the same as this number here, by definition, it's obvious, or it seems natural for the central bank to directly refund the commercial bank. So why doesn't the central bank sort of extend a loan to the commercial bank, which would then immediately replenish the funding also of the commercial bank? Now, is this a complicated operation to enact? It's not at all, if you think about it. What is happening if we, the households, the customers, are withdrawing some funds from our deposit accounts and we want to transfer them to this new CBDC account at the central bank? What is happening is that the central bank sees automatically when this payment is coming from Piraeus Bank to the central bank, then the central bank has to decide, am I going to accept this incoming payment or am I not going to accept this incoming payment? If the central bank says, no, I don't accept this incoming payment, then story is over, nothing has changed really. But if the central bank says, okay, I accept this incoming payment, then by the very act of accepting this incoming payment, the central bank has automatically refinanced Piraeus Bank, because now central bank has a claim vis-a-vis Piraeus Bank. So it has already refinanced Piraeus Bank. So this is going to happen actually automatically. This dots corresponding to this refinancing the commercial banks is an operation that will take place automatically without anybody taking any decision, except for the decision, yes, I accept this incoming payment from the deposit account at the commercial bank to the new CBDC account at the central bank. So the only question really is, how long is the central bank going to maintain this exposure? Are they going to call the bank a day later and say, you know, we are not going to maintain this exposure to you. We want to, you know, sell that, or we want you to repay this. Or more importantly, the question, you know, at what interest rate is the central bank going to extend that loan to the commercial bank? So that's the second feature we have to look at. Let's compare the funding cost in two worlds. In the first world is the world that we are living in, the two-tiered monetary system. If you think back of the balance sheet that we saw on the previous slide, what is it that a bank has to pay to get funding from households or from the private sector? Suppose the bank issues 1 unit of deposit, €1 of deposits at some interest rate, which I call here RD, so the deposit interest rate. And of those deposits, of this €1 of deposit, the bank invests a share SEDA in reserves. Remember, we had this up here. The bank issues deposits, and then of that, a share SEDA, it invests in reserves, and the remainder it invests in loans. So of this €1, it pays RD, deposit interest rate. It invests a share SETA in reserves and earns some interest rate RR, that means the interest rate on reserves on that part. And the rest, 1 minus SETA of this euro, it can invest in loans in the real economy. Suppose also, to make that a bit more general, that there's some cost for the bank of running the payment system on behalf of its customers. And this cost per euro of deposit, say, is new. So what the bank really has to pay in the end to be able to extend 1 minus SETA of funding towards firms in the real economy is that it has to borrow 1 euro of deposits at this interest rate RD, net of which it gets some return on its reserve holdings at the central bank, and then also some cost new that it will have to, and I should have added this actually, sorry about this, there should be a plus rather than a minus, the cost here for the payment operations. So that's the funding cost in order to being able to extend a loan in the current two-tiered monetary system. Now let's compare this with the funding cost that a bank would have in this new world, in the CBDC world, and to make it very transparent and clear, let me assume that we withdraw all of our deposits. So the bank has zero deposit exposure anymore, zero deposit liabilities anymore. We get all our money, we move to the central bank, and then the central bank refinances all of that or rechannels all of that back into the banking sector. So the bank now is a debtor only of the central bank in that new world. So let's look at the funding cost for the bank in that world. again, if the bank wants to be able to extend 1 minus zeta euros to the real economy, to extend loans of that amount, it needs to now borrow from the central bank exactly that amount of funding that it wants to extend to the real sector. So it needs to borrow 1 minus zeta units from the central bank. And let's suppose this happens at some interest rate R, which is the thing I'm interested in really, that interest rate. So to make the funding cost the same as before, the following equation would have to be satisfied. In the new world, I have to borrow 1 minus zeta from the central bank, and I pay some interest rate R on that. So that's the funding cost in the new world, in the CBDC world. What was the funding cost in the old world, in the two-tiered monetary system? Well, it was what we discussed before, this expression here, which I put here on the right-hand side. And again, sorry, there should be a plus. But basically what this equation now is giving you, it is telling you, if today we have this deposit interest rate and we have this reserve interest rate and we have this zeta and this nu in the current regime, then this equation tells you what the interest rate would have to be that the central bank charges the commercial bank in a CBDC world such that nothing would really change for the banking sector. They would basically live in the same environment as before. They would have the same amount of funding available to extend loans to the private sector, and they would pay the same cost for that funding net as they do in the current environment. So that's what this last equation tells you. Now, how can we use this last equation? What we have seen from the previous argument, if you buy into that, is that essentially, and I've just talked about the banks, if you want to make the argument watertight, you have to think about other aspects, but nothing will change. This is really the core of the argument. So what we have seen here is that the status quo world, the two-tiered monetary system world, is equivalent to a world in which we have CBDC, and the funding hole sort of that opened up at the bank is replenished by funding that comes from the central bank at a particular interest rate that I had derived on the previous slide, namely this interest rate R that we had on the previous slide. Now you can ask the question, okay, in this new world, should the central bank really provide that loan to the commercial bank at this very particular interest rate R, or why not should it just charge the regular interest rate that everybody would have to pay? After all, the commercial bank in that new world doesn't do anything specific anymore, right? In particular, its liabilities are no more a means of payment. It's just that the commercial bank borrows some money from the central bank. So this is just a very common liability. It's not used as a means of payment. Why should it have a very particular low interest rate? There's no reason for that to have a low interest rate, because the central bank loan or the central bank funding of the commercial bank is not some liquid stuff in any sense. So a natural price for that would actually be the regular risk-free interest rate, the regular interest rate that everybody would have to pay on some illiquid funding. Now, if you buy into all of these steps, then the conclusion is that by this equivalence result, in the current world, the banks actually benefit from an implicit subsidy. And this implicit subsidy is how large? Well, it is equal to the difference between the regular interest rate that the central bank would charge the commercial banks in a regular situation, RF. And on the other hand, this interest rate, which the central bank currently implicitly charges the commercial banks by allowing them to create money, to create inside money and running this two-tiered monetary system. So this is in a sense the spread that the banks save on each unit on deposit funding that they have in the current system. And then you multiply this with the total amount of deposits that are circulating, and you put it in relation to GDP. And this gives you a number that tells you how much as a share of GDP banks benefit in terms of their funding costs being lower than they would be if they were to pay sort of the normal interest rate. That's what this is supposed to give you. Veni, I have like 5 or 7 minutes or so left. Is that correct?
10.
10. Thank
Yes.
you. Thank you. Okay, so let's now take this seriously. This is all I wanted. This is all the formula, if you want. So relax. Now it's getting more hands-on. What I'm doing is I'm basically taking this equation or this expression here. In the model, it's a bit more involved, but basically that's the story. And I go to you, and I use US data and I compute that number. So the question is, how much did US banks in the last 20 years benefit from the fact that they are able to create money, inside money? And how much of that, therefore, would be at risk if we were to move to a retail CBDC system? So in order to do this calculation, what you need is, on the one hand, you need to know what is the RF, that's the risk-free interest rate, that's easy to observe. You need to know how many deposits are floating around in the US relative to GDP. And you need to know what this sort of hypothetical interest rate is that reflects the funding costs for banks in the current system. If you go back, we computed this R, and it was related to a couple of other elements, other interest rates, the reserve to deposit ratio, the operating costs. So for this, you need data. And if you have the data, then you can easily compute this number. These are the interest rates in the US. All of these are gross interest rates, so 1 plus the interest rate, and all of this is adjusted for inflation. The red line is the risk-free interest rate. The green line represents the deposit rate, and the blue line represents the interest rate on reserves. And this runs from 1999 to 2018, something like this. You see, these interest rates are different before the financial crisis, and since the financial crisis, there's been quite some compression of interest rates. For long, they were basically identical, and now in the last couple of years, they have started to diverge a little bit again. This is the zeta, what I call zeta, so the ratio of reserves relative to deposits. It was basically 0 until 2008-9, and then in the financial crisis, this thing jumped up to, say, 30–40% of deposits. So since then, banks hold much more reserves relative to their deposits than they did before the financial crisis. Now, if you put this together, then, and there's two lines here because there's different measures for that, but it doesn't really make a big difference. So then here you see the implied equivalent interest rate, I call this. This is what on the slides I simply called R. So this is the hypothetical interest rate that the central bank would have to charge the commercial banks in a CBDC world such that the commercial banks would basically be unaffected by the introduction of CBDC. And this interest rate was about, say, 1.5% early on, and then it has come down to a negative interest rate in the last couple of years.
Okay.
This is the implied funding cost reduction. So this is now giving you the answer to the question, how much profits did the banks make because they were able to create money, or because they are able to create money? And this is a number that varies between, say, 0.5% of GDP early on the sample. It moves around. It goes to 0.8% of GDP just before the financial crisis. And here it has actually been negative for a couple of years. Why has it been negative? Because in those years, the interest rates were very much compressed, if you remember. So whether the bank would pay a basic loan or the interest rate on an elementary loan, or whether it issues deposits and pays interest rates on deposits and all this kind of stuff that I described before, it wouldn't make a difference for the funding cost of the banks. But in the current system, the banks also have to cover the cost for the payment operations. This was this parameter nu. And as long as this is positive, which it is, the current, in those years, the banks actually were worse off by getting deposit funding and having to, work with and make the deposit operations on behalf of their customers. This was a worse deal than just getting a straight loan and paying the interest rate on a loan from the central bank at the same interest rate than the interest rate for deposits. Now, in the recent times, this has now come back a little bit. There's different ways to compute that. The series look a little bit different, but the qualitative feature is very much the same. So big profits before the financial crisis and none, or in the previous version, actually negative profits after the financial crisis. So summarizing, the funding cost reduction due to the ability of banks to issue deposits varied between 0.4 and 0.8% of GDP before the financial crisis and has come down a lot after the crisis and now is gaining ground again. And if you compare this to the national account data in the US, you see that this is a significant number, right? In the financial accounts, the financial sector has profits between 2 or maybe 3% of GDP. During the financial crisis, negative, but this is the magnitude we are talking about, and sort of that is the part that is contributed by money creation. Okay, let me just put this last slide here. What are some of the implications of this if you buy into that? The macroeconomic effects of introducing retail CBDC are probably not as big as many people who are concerned about that fear. But it depends really on the central bank's response. So the question is not that much, will CBDC disintermediate banks? The question is rather, what are the conditions or the terms under which the commercial banks are going to be refinanced by the central bank? This will happen automatically, at least on impact, but it's not clear what the conditions for that are going to be, what the prices for that are going to be. And those prices will be decisive if you want to understand what the implications for the banking sector are going to be. The major implication is therefore not the narrow macroeconomic one. The major implication rather is that in this new system, things become explicit which have been largely implicit in the current system. So the fact that banks benefit from money creation is something that you don't read off very easily from statistics. In that new world, it would be very transparent, because in that new world, we would live in a system in which the central bank would directly lend funds to the commercial banks, and the terms of that lending would have to be made explicit. And of course, in the political process, there would be questions being asked what the right price for that lending should be. And that is really the major implication, in my view, of moving to retail CBDC. It's not that the macroeconomic relations per se would change, but some of the implicit things that we're having in the current system would become more explicit, and this poses a lot of questions about whether voters, governments, interest groups, etc., would be willing to support the status quo or whether this would change. Thanks very much.
Thank you very much. Thank you. Well, we have a lot of questions. I guess that they are of different types, meaning that you gave the aspect of how the CBDC will work with the central bank and the commercial bank. A question on this is one. Is from your last point that shall we have one lending rate, or it would be subject to the risk profile of the bank? And if it's this very clear, what I mean is that should the central bank use different rates if it's Piraeus Bank, a Greek bank, or a bank that had problems in the past, in the near past? Because here I have to say that you mentioned Greek banks. Greek banks did well, let's say, because of the cheap money. So they didn't have enough deposits, actually, because they in 2015 we have a bank run. So let's say that we have the CBDC and we have a crisis like this. It seems that the banks are already struggling to have fees. they charge everything. They charge because you just enter the building. And from the other hand, we have the CBDC and all these facilities and the disintermediation tools that lowers the fees or make them zero. Can you a little bit elaborate on that? Can we put some points, some bullet points?
Let me try, Vinny. So I think I mean, if I understood you correctly, you have a couple of questions in mind. Let me first point out that what I was talking about was not, I didn't say anything normative so far. So I didn't say we should or we shouldn't do that. It was a statement that was basically an equivalent statement.
Yep.
So it was arguing that if in this new world, we wanted to make sure for some reason that nothing changes, including the position of the commercial banks, then the central bank would have to extend its loan to the commercial bank at a very particular interest rate. And what these calculations give you is just this interest rate. And from this, you can back out how much it's worth in the current system that the banks can create money. So you're asking, would that interest rate be a different interest rate for different banks? And the answer is, I think, yes. According to that logic, that interest rate would be, if you go back to that equation, if in the current world you see, suppose all the banks, the Greek bank or the Italian bank or the French or the German bank, they get the same interest rate on their reserve holdings because it's deposited at the ECB or in the Euro system. Suppose that's the same interest rate on reserves here. But they might pay different interest rates to their depositors because maybe the Greek depositors are asking for a higher interest rate on their deposits than the German ones, say, for some reason, maybe because they fear these are riskier or whatever. So from this, you would find that indeed the interest rate at which the central bank would extend its loan to the respective banks would also be different, if it wanted to make sure that the funding cost for those banks is the same. So I think that's one part of the answer. So if you just want to have equivalence, yes, you would have to charge different interest rates to different banks, reflecting what their deposit interest rates used to be before CBDC was introduced. Now, another question that you're asking, I think, is with this loan that the central bank extends to the commercial banks, would the central bank be happy to do this? After all, banks are risky and some of them go belly up and you never know. And central banks are risk averse. They don't easily want to lend money to commercial banks without being safe that they get the money back. So in particular, one question is, I think, in the model that I'm showing you, and the argument that I've shown you, the central bank would refinance the commercial banks at this particular interest rate, but otherwise no conditions imposed. There would be no collateral requirements, for example. And that is something that central bankers would typically, say, no way. If we want to give a loan, if we were to give a loan to the commercial banks, we only do this if they give us sufficient collateral for that. So that would be a reason for the equivalence already to be shaky. It depends a little bit, but it could already undermine this equivalence. But if you think about it, this really points to a much more interesting question in my view, which is why in the current system in which we as depositors hold deposits at the commercial banks, trusting that those commercial banks would in the end get some lender of last resort support from the central bank if needed, why don't we require collateral in the current environment? When you have an account at Piraeus Bank, you have these deposits there without asking the bank to provide you with collateral for that. Although in the end, you trust that the central bank will step in to guarantee the liquidity if things go worse. In the new world, the regime would be very much the same. In the end, the basic liquidity would be provided by the central bank through CBDC, as it is now through the lender of last resort requirement through the central bank provided. But in this new world, presumably the central bankers would ask for collateral. While in the current world, they don't ask for collateral, although they give this lender of last resort guarantee to the commercial banks, which make us accept deposits as a means of payment, right? So there's a bit of asymmetry, and we all know that there's a bit of schizophrenic behavior in the monetary system, in the sense that we all know that in the end, or we all trust that in the end, it is really the central bank in the background that supports the system. But at the same time, we are all aware that there are typically, at least in normal times, many more deposits than reserves in the system. So there's some mismatch or some cognitive dissonance, I think, between the world that we live in and why we trust deposits as a means of payment. So these are, I think, interesting questions that the equivalence result points to.
Okay, something else. Is it equivalent to cash? This is a question coming. It's a long question, but I try to summarize it. If it's like cash.
Whether CBDC is like cash.
Yes.
And there is, in principle, in what I have said here, there was nothing per se that made this digital or blockchain based or whatever based, right? It was just that the main difference here was money that comes from the central bank. I called this CBDC, or money that is issued by a commercial bank, private money. I called this deposits. So this is really the issue, right? So in principle, you could think about this also as cash, but then at the same time, at least the way that I imagine a CBDC, to me, it would be more realistic to think about that as a substitute for deposits, right? It's a digital, it's an electronic form of money. I would use it to pay my rent or to pay a car or something. I would probably not use it that much to go on the market and buy a kilogram of apples or oranges or something like this. Now, having said this, introducing cash in the argument doesn't change anything. The only thing that really matters is if you introduce this new thing, from my perspective matters, is how much do we as customers withdraw from our deposit accounts and thereby reduce the funding for commercial banks and shift that into funding for the central bank. That's really what is going on. Now, if you had a worldview in which the central bank has issued reserves to the banks, it has issued cash to us, households, and now it introduces CBDC, and all that happens is that we sort of reduce our cash holdings and instead hold CBDC, then the banks would not be affected at all from the beginning, right? This would be something going on orthogonal to the banking sector, and there would be no worries, I think, about banks being disintermediated, etc. This would just be a switch from one central bank liability, cash, into another one, CBDC. For the households, you know, they would now hold a different means of payment, but for the balance sheets and the funding costs of banks, it would not make any difference at all. So that would be sort of a non-problematic introduction in the view of many central bankers. What I have described here is really the scenario that many central bankers view as problematic because it affects the balance sheets of the banks.
Okay. If we say that CBDC and cash are more or less similar, there is something very different. I mean, the anonymity that the CBDC provides. And it's like a joke, because if you have a check of 10,000, Piraeus Bank will need a statement from you, from wife, from your children, from your grandfather, I don't know from where, just to make sure that it's not some money laundering.
Yes, yes. Yeah, so I agree. I mean, CBDC and cash have very different properties in terms of the individual features that they provide for a user. And I have in my what I said before, I had nothing really to say about that, because these are, in my view, more microeconomic issues rather than the macroeconomic consequences. But these are very important questions indeed. And central bankers are thinking about if they were to issue CBDC, what form that could have or should have, because obviously they don't want to undercut some initiatives by the rest of the government, so to speak, in order to avoid tax evasion, money laundering, all the kind of things you mentioned. So clearly that would not be a perfectly anonymous and private means of payment, at least most likely not. But there's ways to find interesting compromises between, on the one hand, having a means of payment that would not allow too much criminal activity, so to speak, and at the same time to provide some degree of privacy to the users. Actually, there's a recent paper by somebody at the Swiss National Bank, Thomas Moser, together with David Schaum. They are discussing how you could actually construct such systems with the right cryptographic tools to get interesting compromises between these different objectives. Now, I had nothing, I've nothing said about this, and I don't know much about that at all. It would not, again, it would not affect the macro perspective about bank funding and how this affects the different balance sheets and the funding costs. But it would, of course, determine the degree to which households would adopt it, right? I mean, so what I call delta in this slide here, this is dependent on many of those things, right? Would you and I use it or not depends on these kind of issues, I think.
Yes, because if it's just digital, I mean that it's more, it's easier to adopt a digital and online tool of the bank rather than use something that's it's unknown, and also the central banks have very different attitudes in terms of the client with the central bank. Because if I have complaints with my bank, I will call them, I will write something on Twitter. In general, there are a lot of things to do. I think it's not the same to call Bank of Greece and ask for your password or something.
Yes, sure. I mean,
like that.
Yeah.
Okay, just a final question. A question and a comment I will ask from you. A comment about Libra, and there is also a provocative question. I will keep the anonymity of of the participant. He says that is it some kind of IOU, the CBDC?
An IOU.
Yes.
I mean, what is an IOU? I mean, an IOU means I have a claim vis-a-vis you. Everything is an IOU in that sense, right? I mean, money is everybody can take a piece of paper and write on that piece of paper, I owe you whatever.
Yes. Okay. Let me be more specific. It's a very hypothetical question. The root of the question is it possible the CBDC to be used as a parallel currency? We have some experience on that.
A parallel, I mean, what is the currency in the current system? It is the euro in Greece. And what is the euro? I mean, is the euro that is issued by the central bank in the ECB in Frankfurt? Is it the euro issued by the ECB in the form of reserves that is just the digital money that the banks have access to? Or is it the euro that the ECB issues in the form of banknotes that we can use ourselves? These are two different forms of the same thing. They happen to have the same price in the current system, and the central bank is very concerned about making sure that they have the same price. Or is the euro a deposit that you have at Piraeus Bank? I mean, it also has the same price, which is to some extent maybe surprising, right? That they all have exactly the same value, but of course this is due to government guarantees in the background and the central bank making sure that this is typically the case. In the new world, you would have just another form of reserves, which would be the same reserves that we already have today, namely the liabilities of the European Central Bank vis-a-vis to some commercial banks. But now these liabilities, they would also be accessible to households, to you and me. Now, I think the natural thing would be to expect that they have the same price. So in that sense, they would not be a parallel currency, but they would be the same currency that as the one that the banks can now use. We would also be able to use them. Having said this, some people are concerned that the bank disintermediation that I wanted to discount a little bit here, that this could be a problem, and therefore they are arguing, actually, people at the ECB, for example, they are arguing that the CBDC that we would be able to use should be capped. The amount should be capped. We should, for example, only be able to have like 3,000 euros in such a CBDC account. And that would be interest free, for example. But if you want to have more than that, you would have a different interest rate on this. And this introduces sort of different currencies in some sense, right? It's not exactly the same stuff anymore. That opens interesting questions along the lines that you described. I mean, is this still the same thing, or do we talk about segmented markets here? What are the implications? It's interesting.
Yeah. And the comment about Facebook Libra. Just to mention that the web page, the first thing you see is a lady from Africa.
Yeah. Okay.
So what I think, let's say that completely agnostic, it's something that help people who don't have access to finance.
Yes.
That's in my opinion, the first reaction to this.
Yes. I agree. I think certainly this is a big motivation. Financial inclusion is what you describe, and this is a major motivation for going digital. Also for example, if you think about the Bahamas, which introduced digital currency recently, there was less financial inclusion maybe, but simply to making it much simpler to run a payment system. If you live on hundreds of islands and there's a regular hurricane going through every other week, then it becomes easier to have some digital means of payment than having to handle cash across all these islands. So financial inclusion and convenience in some sense, these are motivations, I think, that people take seriously for digital money. Now, this could be CBDC, or it could be a private money like Diem or Libra, as you described, right? And the consequences are, for the users, I think, very similar, depending on how this is exactly done, but it's similar stuff. But for the governments, it would be very different, of course. And in particular, if you're in a developing country where Diem or Libra might be attractive for the users, it could have very different implications for the government, whether the government is able to issue a CBDC itself, or whether it is not, and instead the private sector jumps in and issues a private money, and then everybody uses Libra or Diem in that country. And it's particularly interesting in developing countries, because in developing countries, many users, A, don't have a bank account, and B, if they have one, then they're very much subject to forms of financial repression. So they pay high fees. The banks might not be very well managed. There might be corruption between the government and the banks going on. All of this makes it sort of very, very costly to have a bank account or to be financially active in such a country. And then Libra would, of course, make it presumably much easier and cheaper for those people. But since Libra is backed or invested in the major currencies, now in the dollar in the first version, essentially somebody in a developing country who would start holding Libras or Diem, this guy would essentially be holding dollars, because the Diem or the Libra would be backed by dollars. So this guy would essentially have a chance now to move out of the developing country monetary system, where they hold currency X because they have no choice essentially, and suddenly they would be able to indirectly hold the dollar or the euro, whatever currency Libra would be backed by. And that would of course mean that the local government would lose seigniorage revenue, it would lose influence on the monetary system domestically, and that is a very unattractive perspective for governments. And therefore, I think that Libra, as I wrote a couple of years ago, I think Libra is basically pushing governments to be much more open towards this idea of CBDC. It forces them to, because if they don't do it, then the private sector will do it, and they would lose leverage on the monetary system.
Okay, thank you very, very much.
Thank you, Veni.
We enjoyed the discussion. Let's have a short break and be back at 12 o'clock. Thank you. Thank you. Thank you very much. Thank you all.
Thanks. Bye-bye.
Bye.
Hi, Benny.
Good morning, Yanis.
Good morning. I wanted to check that, okay, everything is working.
Yes, of course.
Good, good. Okay. Can you see my chat also?
Yes, indeed.
Okay, good.
Okay, Andres is not here yet,
Okay.
but saying so, I will forward his slides because he's afraid that he won't be able to
Okay.
share.
Yeah, good.
So let's me
see. Let's make
yes,
sure that
I already have them, but
Good.
it's better you to have since
Yeah.
you are the moderator.
Yeah, and he prefers me to show them, I believe.
He will try to do by himself,
Okay.
but just
to
in
make sure.
case
Perfect.
to
Yeah,
be on the safe side.
perfect. That's a good idea.
Mhm.
And then I'm going to look for Daniele.
Yes. Hello, Andres.
Hi, Andres.
Hi, hello, do you hear me?
Yes, very well. Can you try to
good.
share your
Good
talk?
start.
Yeah, so I'm Yanis. I'll be chairing the session. So let's try to see your
screen.
Yeah, if you can share your talk. Do you have the rights to share, Andres?
Yes.
I'm not sure if it's me, but the connection seems to be the best, so I might actually hear what Yanis is saying.
So if you think that it's a poor connection, I could show them. What do you think? Screen to make sure it's working.
Hey, I will try.
Okay, that's good.
Are you able to see it?
Yes, we can see it.
Okay.
We can also see the notes if you don't mind. Otherwise, you can choose the the projector
yeah.
option.
You still see the notes?
Yes.
And now?
We still do.
Okay, I think I don't have any notes, so no secrets there, but I'm not sure actually how to change it.
Yeah.
I think it would be more convenient to see it in full screen, but yes. Yeah. Would you mind to share that from your side and just
What do you say? So Andres, should we start like this?
Yeah, if it's either this way or maybe Benny would like to share from her side, so we can see the full slides. But to be honest, I don't mind doing it this way as well. I don't have any notes, I think, in the.
Good. Okay. So let's do. I also have your slides if as an alternative, but I think it's better if you control it. So let's start the session then. Okay, so I would like to welcome everybody to the new session. We are focusing on InsurTech, which is a very hot topic these days, and we are very glad to have representatives of the Helix, as we say. So without further ado, we'll start with our keynote speaker, Andres Letmets, from the European Insurance and Occupational Pensions Authority. The talk is already on our screen. It's on open insurance and about accessing and sharing data which is related to insurance. So I'm looking forward. Andres, the floor is yours.
Mm-hmm. Thank you for this introduction, and hello to everybody from my side. Again, apologies for this small technical issues in the beginning. I think this is somehow the Murphy law. It usually happens, especially when you are talking about the digitalization related topics. So what can you do? I'm really pleased to be here today and then maybe talk about a bit from EIOPA's side, what we are doing in relation to digitalization, in relation to the InsurTech, but focusing indeed on open insurance. Maybe a bit of my background. As said, I'm working in EIOPA in EIOPA's digitalization team and acting also as a rapporteur for our InsurTech task force. So this is the specific working group where we work on different digitalization related topics together with our members, national supervisory authorities. A bit of introduction, broader introduction, maybe just to mention that, of course, the digitalization has been now the focus of our work for some time, and we've done quite a lot of this on this field, and of course continue doing so. For this year, maybe to mention a couple of work streams which we are going to do. So we are now in the process of publishing a discussion paper on blockchain and crypto assets to explore a bit what does it mean for insurance consumers, for supervisors, and for the industry. What are the risks? What are the benefits there? So this should be published in March. We of course continue work on AI, on big data, and digital ethics. We have created a specific stakeholder group on digital ethics where we where we are working on these issues and ultimately aiming to publish certain principles related to digital ethics, and this work is planned to be end in Q2 this year. We are also continuing work on reinsurance value chain and new business models, where we've been already published a discussion paper and launched a public consultation, but we are planning now to do a follow-up work on this as well, focusing on, or maybe deep diving a bit further on the issues of platformization, insurance ecosystems, and then implications again for supervisors, for consumers, and the industry. And then the work on DORA, of course, is also related to that. Taking into account the broader curriculum of today's event, I talked to focus today more on open insurance, which is one of our recent work, and here it's of course it's a broader, let's say, you can call it, let's say, a discussion around enabling broader enabling policies. So it is linked to the economic side, competition side, data protection, digitalization in general. So ultimately a broad topic. If we quite often it's asked after we published this paper, it has been asked what is our aim here, what we want to achieve here. So maybe to start a bit broader again, I think it's somehow fair to say that the discussion around open finance has been taking place now for some time in different jurisdictions, both in the EU, where we of course already have the PSD2.
Andres, excuse me.
Yes.
Andres, we are still watching. We are still seeing your first page. Is that correct?
You still seeing the first page?
Yes.
Okay, strange. Let's try again. How about now?
Yeah, now it's good. Now we see the next
and
one.
If I change, you can see that I'm changing now.
I can still see the notes, but it's okay.
Okay. So we are in the slide background and rationale, right?
Exactly.
Okay. So here, as I said, the discussions has been taking place for some time, focusing so far mainly on banking side. The discussions are taking place also outside of the Europe. We can maybe mention here Singapore or Australia, where the discussions are now going on open banking, but also extending this to the other financial services. And of course, in the European Union, if we look at somehow the recent EU policy initiatives recognize, of course, that the importance of the data-driven innovation, in addition to PSD2, maybe to mention the GDPR, General Data Protection Regulation, and data portability rules there. But also more recently published European Commission data strategy and digital finance strategy as well. And the latter, the digital finance strategy, now explicitly also refers that the Commission will be presenting a proposal on open finance by mid-2020. And hence the question also arises, what does it mean in insurance, whether and how far insurance value chain should be opened up more, and whether and how far the insurance related data should be shared among different players included in the insurance value chain. I'm moving to the next slide. Do you see now the next slide?
Not yet.
Okay, strange. Let's see.
Okay. Now.
The definition slide. Do you see this?
Yes, yes, okay.
Next, I would maybe like to open a bit the definition of open insurance and the discussion around there. I think it's somehow fair to say that there's no one ultimate definition. What does this open insurance mean? And if you are discussing it with the different stakeholders, then the understanding of this is different. Sometimes it's understood as let's say in light of PSD2, meaning the accessing and sharing consumer data in a regulated framework. So you ultimately have a specific regulation for that, and it's compulsory to be able to for the consumer to share his or her data between different providers. Sometimes it's also understood as let's say the broader cooperation between different providers, covering also the let's say the more back offices activities. So how the insurers and intermediaries are exchanging, for example, the data between them, or how the undertakings are interacting with the different insurance platforms or ecosystems and so on. So more of this let's call it back office view, but we decided that all of these aspects are important. So we've been looking at it in the broadest sense, covering accessing and sharing of personal and non-personal insurance-related data, usually via APIs. And I'm coming later on this personal and non-personal data aspect. So we've been looking at it from 3 different angles. So the industry angle, consumer angle, and of course from supervisory angle as well. I'm moving to the next slide. Do you see the next slide? Hello?
Not yet.
Not yet.
Not yet.
Okay, so it seems that it's not the sharing is not working. I will try to
now it's okay. No,
sharing.
It did move. Maybe take some time.
Yes.
It did move to page 5 just before you stopped it. It takes some time, apparently.
How about now? Do you see now the slide on consumer angle?
Consumer angle.
Perfect. Let's hope it will work.
It takes time, Andres. It takes time.
Okay, let's hope so. I mentioned different angles, and I start maybe with the consumer angle, and then if you look the consumer angle, then here it's of course different ways how it might work. It enables different new, let's say, new products or new services. One can be mentioned here is insurance policy information services, which is basically mean that you ultimately have a holistic overview of all of your insurance situation, covering your different policies from different providers, giving you ultimately an overview of your insurance situation, what is covered, what is not covered, what are the terms and conditions, and so on. Combining this with open banking, you can also understand the general financial situation of the consumer, for example, which can support both the demands and needs test, but also suitability assessment in insurance. So ultimately, to better understand what are the needs of the consumer. This this insurance policy information services, it can also facilitate switching services to ultimately make it easier for consumers to switch to one provider to another. As we know, consumers are sometimes quite sticky. So even if they know that they get another offer which is better for them, they might not start the switching process because it's too cumbersome. So open insurance solutions can overcome some of these challenges. We see already some of these developments in practice in pension sector, for example, when especially in Scandinavian countries you have holistic pension dashboards where the consumer can have an overview of his or her pension situation, covering both the, let's say, the state pension and also second and third pillar pension. Ultimately helps the consumer to understand better the situation, but also make informed decisions based on that. Combining this with PSD2 or PSD2 data, you can also understand consumers' key life events, let's say, which means, for example, when you're when you are buying a new house or when you are getting a new baby born, then you have this information and you can consequently provide, you know, a new household policy or maybe recommend some new health insurance policies or so on. So it can work this way as well. And again, in practice, I think we already see some of these solutions also in the market in the PSD2 context. Industry angle as well, and here I think increased data exchange through APIs can facilitate the broader industry-wide innovation, but also cooperation, collaboration, and it will arguably enable the insurance sector to fully embrace the data-driven innovation. Again, it can also encourage the creation of new products, new services, which I covered in the last slide. But it can also increase efficiency and interaction with third parties, and again, maybe to mention this broader developments in the platformization and in ecosystems which is taking place currently. I move to the next slide, and of course, from as a supervisors, we also look the supervisory angle of these developments or possible developments. So, what does it mean for, or what might it mean for insurance supervisors? And here, I think the main thing is that it can facilitate further the uptake of different subtech solutions, maybe going further than traditional subtext solutions, and at least theoretically you can have a live overview of let's say the exact product that is bought, both the costs and fees, but also general features of the policies. But
Andres,
also,
excuse me, we are still on consumer angle.
Okay, so it seems that
how did you do it before?
It seems that
okay.
It's not working.
Maybe it will come up now. Also, let's try to, yeah, perfect, supervisory angle. Let's try to keep the time if you okay. Good.
Okay, so the supervisory angle, I think the main benefit is here this possible live overview of different product information, cost, fees, features, information related to claims data, but also maybe consumer complaints, and also ultimately you can see how the, let's say, for example, how the commissions are working and use this for supervisory purposes, especially I think in conduct of business supervision, it provides possible new tools. I try to slide. So then maybe do you see the slide?
Yeah, perfect.
Okay, so maybe the final angle to point out is the broader, let's say, public policy angle, and here the discussion is whether and how far you can use the data for broader public policy making, policy decisions. And I put one example here from Estonia. Basically, this is the map of Estonia, where you have the information about car accidents. All of the car accidents are in one database, and in this database is accessible. Let's say the view of it is accessible to the public in general. Of course, anonymized information, so you just see the accident and whether it was personal or non-personal type of claim, and the amount of damage. So no personal information is included here, but ultimately you can use this information for public policy decisions. For example, you can think that you need to build bigger parking space because in certain supermarkets there's a lot of accidents in the car parking places. Or you can see that in this crossroad there's a lot of accidents. Maybe we should put another traffic light or design it in certain way. So this is also one part of the discussion. Slide, of course, this is just to show that all of these angles, which I already mentioned, they are related to each other. So that the consumer angle, the broader industry angle, access to, let's say, public databases which are already there, and also the interaction with for example, external claims management companies, or I mentioned already the third-party financial management tools, and subtech angle as well. I move to the next slide. I hope you can see this. Of course, through the case studies or the different angles, we somehow looked the positive side or the benefits of this open insurance. But of course, it's super important to also look at the risk side.
Andres, we are still on open insurance ecosystem.
Can you see now the risk slide?
Perfect.
So from the risk side, as I mentioned, especially from supervisory perspective, it's super important to look the risk side as well. Here, what I would like to maybe mention first is that it's actually still hard to foresee all the risks accurately, and of course it depends on so many different things. First, how the market is developing itself, what are the possible use cases, whether there will be or will not be a certain regulator is there on this, or let's say inspired by PSD2, maybe a compulsory data sharing requirements. What are exactly the data sets that should be shared between different providers, and who are these providers who can have the access to these data sets? So ultimately, a lot of variables here which are influencing the risk side. But of course, you can still highlight the general risks related to, for example, the increased data sharing, especially when it comes to personal data. And data breaches, misuse, or fraud can be mentioned here. I think broader operational risks, cyber risk, ICT risks, everything which is which comes to the sensitive information about your political views or health data. But of course also possible financial exclusion issues. So if you have more data available, some consumers with certain characteristics might be excluded from some of the markets. You might also have, it depends on whether you have or not have regulations, and you might have the regulatory perimeter risk. So ultimately a question whether certain services are following under the regulation or not. And also from industry side, maybe to mention the implementation costs. So for example, if you foresee it as a compulsory data sharing, then of course the costs are related to that. Slide. Do you see the slide?
Yes, we see the slide. Let's try to wrap up, Andres, when you can.
Of course. So I think I'm almost finalized. So finally, in the of course in our paper we also highlighted some of the areas to consider further for a sound open insurance framework, and I just briefly mentioned this. One is of course the discussion of different approaches to the open insurance, and both from regulatory and supervisory side. And this is ultimately the discussion whether the market itself is enough to move forward this open insurance development, whether you need some self-regulatory guidance or whether you need hard regulation to actually move this forward. Related to that, you also have the question of proper oversight and supervision, data protection and digital ethics questions, interoperability issues, different standardization questions, but also level playing field and data reciprocity questions. So ultimately a question whether who should be accessing what data sets. I think with this one I can finalize my presentation. As a IOPA, and we have published a discussion paper and a public consultation, which is open until the end of April, and of course looking forward for all the input from different stakeholders. So if you have any views on this topic, please feel free to submit your responses as well. And of course, the broader aim of this is to facilitate the multi-stakeholder discussion on the topic, and it might of course help us to provide informed input also for the commission. As I mentioned, there are different initiatives going on in the political side as well. With that, I would like to finalize my presentation. So if we still have time, happy to take questions, and then apologize for this, again, these technical issues of not being able to share the slides properly. I'm not sure what issue.
Thank you, Andres. Thank you very much. It was very useful. Maybe we have time for one question. Just to... If not, I would like to ask, how do you feel that the companies themselves are ready to adopt such a scheme? So do you think that large or small companies will be able to function and to share data and to use all this new technology? Andres, did you get my question? We cannot hear you. So maybe I would like to ask Daniele to start sharing the new presentation.
Can you hear me? See my screen?
Yes, we can see the screen very well. Of course, Daniele, we also see the nodes around. Would you prefer to put it in? That's perfect. That's perfect.
Okay, done.
Okay, so it seems that Andres, we cannot hear him. So I'd like to go on with the next talk. So I'm pleased to announce Daniele Marazzina from the Politecnico di Milano. And Professor Marazzina is going to talk about machine learning and the model for lapse prediction in life insurance contracts. So Daniele is representing the research aspect of our session. Daniele.
Okay, thank you very much. And thank you very much for the invitation for this presentation. This is a joint work with one colleague of mine, Emilio Marucci, and two our PhD students, Michele Azzone and Giancarlo Giuffra. The research question is the following. We have a data set from one of the most large bank insurance in Italy about early lapse. And therefore, the goal for us is to use this data set to investigate the reason for early lapse decision, as well as to study the usage of a machine learning methodology, in our case, the random forest, in order to predict this. So basically, we have about this data set two works. The first one, which was appear in a European Factorial Journal, is more, let's say, on a classical work of econometrics with logistic regression, studying the significativity of the determinants, and so on. But then the second research question, which is the one which I'm going to discuss with you today, is based on prediction. And the classical technique, like logistic regression, does not work well in prediction. I will show you this. Yes?
Excuse me, can I have a question? Can you define lapse?
Okay.
I'm not an expert.
Yes, for sure. Early lapse means that the insured stopped to pay the premium and so close the contract before the end of the contract. So this is an early lapse. And obviously, this is a problem for a company because the company has in its plan to receive all the payment from the agent, from the insured, from the initial time to the maturity, and then stopping payments also get a client is lost. So so this is the problem.
Right.
To be able to predict when a early lapse can happen, in order also to try to solve the problem. For example, contacting the client. You can have something like a red alert that some of your clients are in the possibility to stop paying the early lapse, moving to other kind of contracts, and so you can try to contact them. So this is the problem, early lapse prediction. This early lapse prediction is a problem which is on the whole insurance contract family. And therefore, we study a data set which cover from 2008 to 2016, considering both the family of insurance contracts, which means the traditional contracts, which are the one which have the guaranteed minimum, as well as the unit link. The unit link are more risky, so are more connected to investment funds. So we both have these two family of insurance contracts, the one with low risk and the minimum guarantee, for example, to get back all the investment capital, or to get investment capital plus a small interest at least, as well as risky contracts. We also have 3 different companies inside this contract, and we have this because the companies refer to different distributors. For example, one only works with banks. So the product of the insurance company are only sold by bank connected to the insurance company. And here we can see the lapse rate for the different year, and the lapse rate only for traditional as well as for unit linked. You see 2 lines because in one case we just consider the lapse rate, and in the second case we weight the lapse for the, let's say, quantity, for the money of the contract, because obviously for an insurance company to lose a client with a very small amount of money invested, it's not a problem. But a large client will become really a problem because of the quantity of premium which are getting lost. Now, I want to describe a little bit our data set. We have information about the client, gender, age, where it lives. We are speaking about Italy. So we divide Italy into 4 macro regions. From which of the company the contract is, what is the time from start, which means the time passed from the incipit of the contract, and what is the time to expiry, so the time left to the contract. In some case, some policies do not have a time to expiry because are perpetual, so we just treat this in a different way, as well as the insured capital, which is the contract size, and the premium. And if it is a traditional contract, which means a low-risk contract with minimum guarantee, or a unit-linked contract, which means that the money are invested in fund, plus some macroeconomic variables like disposable income, inflation, and euro stocks. So at the end, we have a data set which contains 9 million of observations, because for each contract, we have an observation for each year in which the contract is active, knowing if this contract in that year is alive or is stopped earlier. And so it is for us an early lapse. So with 9 million of observation, we have enough data to go beyond the classical technique and to use also machine learning, because now we have a data set which is large enough. So obviously, the first step is always the classical one, which is logistic regression. And exploiting logistic regression to investigate the lapse, we have several analyses and significativity. However, if our goal is more on the prediction, this table with coefficient with, let's say, significativity, and it's not enough, because this does not tell us how logistic regression, if logistic regression is good or not in predicting. And then we also think that logistic regression is too simple. I mean, if there is a large literature that say that logistic regression is not so good with respect to, if compared to machine learning, for example, in predicting default of firm, and early lapse is not so different. So we use a machine learning approach. Our idea is to use a random forest. Now we just take a few slides to better recap what a random forest is. A random forest is a combination of classification trees and of tree backing. So first of all, what is a classification trees? I just start with a plot of a classification tree so we can better understand what it is. I mean, at the beginning, we have all the observations which are splitted according to some feature. For example, here the disposable income rate. If it is smaller than 1.2%, it goes down and you arrive here, otherwise no. So at any step, the observations are splitted inside this tree till arriving to the end, where, for example, in our case, we have in the leaf the probability of lapse, which is value. For example, here say that if we have in a year with disposable income rate smaller than 1.2%, with something which, with a contract of company A, because company are 1, 2, 3, so company 1, and the contract has time from start smaller than 3.5 years, then the probability of early lapse is 84%, so close to 85%. So we have a large probability of lapse. However, I mean, one thing is just to read a tree, the other is to create the best tree. And so this is the role of machine learning techniques based on classification tree, where the idea is that at each step, we find the best feature and the best threshold. For example, here, best feature disposable income, best threshold 1.2%, in order to decrease the so-called node impurity, which is a measure. In our case, we use the gene impurity. Another measure that we can use is the entropy. However, this measure is high when in a node of the tree, there are a large quantity of observation with variable 0, so no lapse, and variable 1, lapse. So what we have is to try the way to divide the data set in such a way that we have node with larger quantity of class 0 or larger quantity of class 1, splitting the observation. And this is mathematically done with the idea to maximize the impurity decrease after the split, which is done mathematically by this impurity decreases function. Even if I now do not want, because I do not have the time to enter into the whole mathematical details. So, however, this, which I show you, is one classification tree, which has a very small ability to predict. It's a white box because we can read it. We can understand what is the way information are, observation are splitted inside different probability of lapse, of early lapse, but it's not so powerful in predicting. And this is well-known literature. And therefore, here we introduce random forest. What is a random forest? A random forest is a forest of classification tree. So instead of using one tree, we use a large quantity of tree, and where we, for each tree, set randomly the observation. So we do not use all the 9 million observations to create the best tree. We just choose randomly a subset. And we also choose randomly a subset of features. And this is known as an improvement, because we averaging, we decrease bias, and we, let's say, improve the outcome of the machine learning technique. So What we need is to set how our random forest look like. So for example, how many trees do we use? What is the minimum number of observations contained in a leaf? Otherwise, I mean, if we have if a leaf contains a number of observations which is smaller than the minimum leaf size, the algorithm stops, as well as other, let's say, information as the number of trees. Now, so as a classical approach in machine learning, what we did once we choose the technique, which means random forest, we divide the 9 million of observation into training set, validation test set, and test set. This is quite usual in machine learning, where we use the 70% information to train the random forest with different combination of hyperparameters. For example, we train the random forest with 5 maximum tree depth, minimum life size 5, minimum decrease 0, minimum split size 5, and number of trees just 1. Very simple model. And then we compare the, let's say, performance in predicting not the training set, but the validation set. This is to avoid the classical overfitting problem of machine learning. So we test the quality of our machine learning machinery of a set which is independent on the set used for training the algorithm, so for setting the parameters of the algorithm. And then the test set is used at the end to say what is the performance of the method. So the key point now is performance. How can we select the best model? In selecting the best model, we need to use something, some information, which give us mathematically a result on the ability of predicting the early lapse of our algorithm. And it is well known that one of the most famous model selection measure, which is the accuracy, does not work so well in this kind of problem, because we have an imbalanced data set, because we have that early lapse are only 15% of the whole data set. So we have to use something else. And in this case, it is known that the best thing is to use the ROC curve, where we plot the true positive rate and the false positive rate together. Just to explain, the idea is that we have a machinery which, given some observation as an input, tell us what is the probability of an early lapse. Now we have to move from probability to classification. And so we have to choose a threshold. For example, we can decide that we classify an observation as an early lapse only if the probability of having an early lapse is 80%. Otherwise, it is not early lapse. Moving all these thresholds from 0 to 1, we obtain different points, plotting the true positive rate, which is nothing else than the quantity of true positive, so of observation that are positive in reality and positive for our machinery, divided by all the positive observation inside our data set, versus the false positive rate, which is again the number of positive observation for our machinery, which are really negative. So for our machinery, it's an early lapse, but this is not really an early lapse, divided again all the positive. And so we obtain this curve. Now, what is the best predictor? The best predictor is the one which is here, 0.01, 100% true positive rate, 0% false positive rate. So the best point is this one. So closer is the curve to this point, better is the predictor. And so here we can compare the logistic regression, which is here, with our random forest. And we can see that it's almost clearly that the random forest is better because, I mean, this curve is closer to this point with respect to this one. We can also see this numerically by the area under curve, which is the area of this curve, which is 0.7 for the logistic regression versus 88% for the random forest. So this is the first step, exploiting this kind of data set. Random forest are a machine learning technique which improve of a large quantity because we move from 0.7 to 0.88 the ability to predict the early lapse. But now we have the second step. We have a machine learning prediction. So, but this is not enough. We need to have some interpretability issue, because it is true, we take logistic regression, and logistic regression is a white box. Then we move to a single classification tree, which again is a white box. We can see and we can understand everything about how the classification tree works. But now we go to a random forest, which in our case is the average of 15 trees. And averaging 50 white box results in a black box. So basically, we lose the control of this interpretability. So we have to recover this. And this is important. Now, I think that FinTech is one of the most important theme that is studied in machine learning, which is how can we recover interpretability if we use a black box. And this problem is solved in two ways. One is the local interpretability problem, and the second one is the global interpretability. What is the difference? Local interpretability is just the idea of being able to explain why a given observation is categorized in a given way by the machinery. So local because it's explain a single observation. And in local interpretability, the most famous is the shape value approach, which comes from game of theory and consists in the calculation of shape additive explanation value, which are a measure of the importance of a feature. So for example, here it's an example of the interpretability. We have the case, we just randomly take one observation from the true positive and one observation for the false positive. So for our algorithm, the observation are lapse, but actually only this is a really lapse, while this is wrong in the assignment of the class. So what are these numbers? These numbers are the shape values, which means that for this observation, the probability of lapse is equal to 17%, which is the bus rate, plus 27% because the contract is given by company A, plus 20% because we are in a year where the discoverable income rate is minus 0.02 growth rate, and plus 12% because we are in a year where the Euro Stocks index is getting negative as a rate. where the time for start is 3, and so it's plus 11%. So summing all this number to the base rate, we obtain exactly the probability of lapse of this observation according to our machinery. And same here. So in a certain way, this shape value help us to give a explanation of the reason and of how the different features enter into the decision. This is local. It's the, you see this for a true negative and false negative. It's obviously the same as before. The global approach is a little more, it's more complex. So if you just want to explain how so generally our black box appear, this is not so easy. So one thing that you can do, and this is what we did, is to say, okay, we want to find the best human readable tree which represents the black box. For example, so therefore what we do is just to apply a new machine learning technique using a single regression tree to try to explain the whole black box. So for example, this is a tree which is very small, so very human readable. It is the best tree with 3 steps which explain our machine learning approach. However, the accuracy is only 45%. However, if we just try to increase, let's say, the number of the depth of the tree, we are quite able to, let's say, recover nearly the 100% of accuracy, even if the 100% is not possible to be reached. What is also important is that if we just want to take, let's say, 5 depth, we use 9 features over 12. And the 12 features only enter into depth 10, which means that probably there are 2 features which play really a weak role in predicting. So basically, the idea is that to have a global interpretability of black box is not possible because it is a black box by definition. However, we can try to use a white box in order to discover what are the main reason, the main, let's say, step, the most important features inside the black box. So in a certain way, it's something like to use, okay, we have a black box, which we can use for prediction. And we have a white box, which can give us some information about the way the black box is working. For example, here we can understand that the disposable income play a very important role because it is the first split. And then also that the company are very important. So the business model of a company play a very important role. And this is something which does not appear in the logistic regression. In the logistic regression, the variable of the company has no significance. So its p-value was too large. But here we see that the business model is really important. So it's not only the effect of economy, it's not only the effect of the time to expire or time to start of the company, but it's also a matter of the company business model.
Daniele, excuse me.
Yes?
We have to conclude.
Yeah, but I have concluded. I mean, I'm tied to the conclusion, so it's perfect.
Good.
So, to conclude, the idea is that we investigate the early lapse phenomenon in, let's say, an agnostic way, using the machine learning tools in order to allow data to speak. Doing this, we were able to obtain a black box with a good accuracy in predicting the early lapse, And then we find, exploiting our global approach, the fact that there are behavioral and commercial reasons that play an important role in the the early labs decision. And that's all, and thank you for the attention. If there are any questions,
Thank you, Daniele. We have a short time for questions. Anybody can turn on their microphone.
I have a technical question, if I may.
Okay, Veni, please.
And if it's a short one, how stable is your machinery? I mean that you have all the sort of observation. I think you have also missing variables. And I think that convergence is really hard. So do you have any reservation on the methodology, something that you would like to see for further research? I mean, it's a hot topic. We love to see more results on that. I'm asking. Okay. It's not a provocative question. It's a question that any researcher who knows the difficulty and appreciates the results might have such questions.
Okay, so first of all, luckily we had the data set which was cleaned, so we do not have to, and which is, I mean, we had a good connection with the insurance, so the insurance company gave us a clean data set. The only field with missing variable was the job. I mean, for example, the job of the person, which is very, very important variable, but which at the end we decided not to use for two reasons. The first reason was that half of the observation or half of the contract do not have this information. And the second is that we investigate if the insurance makes some control in order to understand if what people told was correct. And there was no control on this. So basically, I mean, we were quite impressive that there was a large number of people that answered that they work with a lion in the circus. And I mean, it was so strange. So at the end, we decided to delay this. Obviously, one of the most important things is that there are variables which probably play a very important role that are very hard to be used. Mm-hmm. So this is one of the points that, in my opinion, has to be of interest. So obviously, it's, I mean, now we are still working on this. We are trying to enlarge the data set, taking also other features from interest rate and so on, in order to do not consider here can change deeply the model. Mm-hmm. At the moment, it seems no. Even if I think that probably if you have this kind of feature from economy, they do not change. But for example, if we have a clean data set with all information of the job, for example, this be relevant and maybe change the driver.
Okay, thank you.
Yes.
Okay, thank you, Daniele. It was very useful. I liked it. I understand it's technical, so I liked it a lot. It's time to move on to the next talk. I would like to welcome Zera Chataltepe, who is co-founder and CEO of Tazi AI. It's a pleasure to see some very strong and fundamental work that was developed in an academic context and then moves on to innovation and finally making an impact in real life. So I'm looking forward to listening to this talk. Zera, the floor is yours. And the title of the talk, I should say, connects very well to the previous one, because Zera is going to explain to us how to do explainable and enterprise-wide AI for customer loyalty in finance. So a similar topic like before. Sarah.
Thank you so much, and greetings to all of you. And I wish I could be there personally, in person, but you know, COVID has enabled actually also us, right, to get together easier. So I hope we can have a meeting face to face and have, you know, a good cup of Turkish or Greek or Armenian coffee, whatever you want to call it. So thank you for the previous discussion, because I feel like I'm playing volleyball and the ball has been hit my way and I'm about to just hit it. So thank you so much, because you laid the ground for a lot of things for me. So this is my presentation, and this is in Keynote. So what I find out is sometimes as I go down the pages, the screen might not move. So what I'll do is I'll start the presentation. If it doesn't go down the pages, I'm going to go back in this mode. Okay, so just let me know if it doesn't move down.
We can also look at your side panel, but it's okay.
I know. I don't want the side panel to be seen, but just let me know if I can go to the next page or not. Sure. Okay. All right.
Of course.
So I'm excited to be speaking about explainable and enterprise-wide AI for customer loyalty in finance, and I'm the CEO and co-founder of Tazi AI. So just one page about Tazi. Did it go to the next page? Or
not yet, but it takes time. We saw that in the previous talk, in the first talk, not the previous one. Okay. Maybe it's just, maybe give it a couple of minutes, but not minutes, seconds.
Okay, because if it didn't, then I'll just.
No, it's still on your cover. Okay, now, okay. Yeah, now.
Yeah. Okay. So unfortunately, Mac sometimes Mac just doesn't work for some stuff.
Yeah, we saw that.
Some rare stuff. Okay.
Yes.
So yeah, let me do this. Okay, so I'll have more space on my screen.
That's better, yes.
All right, and less space for these guys. All right, okay. So, I'm an academician as well as the CEO and co-founder of Tazi. Our mission at Tazi has been to create complete solutions which are easy to deploy, and we include our clients in the AI deployment processes. So at the end, we want to, and we do have usually a working system in 4 weeks, because we are able to do that, because we take AI to be not a data scientist job, but a whole enterprise-wide task that needs to be handled. And we create self-maintaining AI systems thanks to our continuous learning and business user-focused solutions. And I'm a data scientist, I'm a machine learning professional, but I have learned that every business is very complex, especially if we are talking about finance, insurance, retail. We are talking about many decision makers and continuously changing environments. So business user-focused is a must if you want to have a successful solution. As Tazi, we are a Gartner cool vendor in core AI technologies, one of the deep tech 500 companies in Europe. And also, we just graduated from Alchemist Accelerator, which is one of the best B2B accelerators in Silicon Valley. So we have a worldwide presence with headquarters in San Francisco. Today, I want to talk about first two problems: continuous change and data scientist talent shortage. That's why those two reasons are why we need explainable AI. And not just explainable AI. I liken explainable AI to, a disaster is happening and you have a glass wall in front of you and you just see it, but you can't do anything about that disaster if you are not able to interact with your AI system. So we provide explainable AI with interactions for business users, because again, if something is going wrong with your AI model, the responsibility should not be only on the shoulders of the data scientists, because Sometimes they may not be able to understand what is wrong. And you need really the business people's expertise and insights to make things really right, or to realize if something is wrong much early. So we have interactions of 3 forms. One of them is business actions directly, and there on the interfaces, not later, not you say to your data scientist says to someone else. So direct business actions, business users making the AI models better AI models by contributing to them through easy to use interfaces, and also giving feedback to the AI model. So human in the loop, but again through easy interactions. So for all of these, we are saying business user oriented, but I also have to tell you that I don't think that serious AI models can be just 1 or 2 or 3 click solutions. You need the business expert as well as a data scientist or a data expert who is able to take necessary actions. So we allow the business experts to take actions up to a level. And then if you need deeper actions, we also allow the data scientists to get in. So we make the data scientist's job easier, but also we include the business expert all the time. And then finally, I'll talk about enterprise-wide AI, because this is a trend that we see again and again with our customers. When you want to prevent customer churn, it's not enough to just have one model that says your customer will churn. You have to have enterprise-wide AI. In other words, a number of models working together coherently for a number of reasons. One of them is your AI model might not be fitting all your data. You might need to divide and conquer and fit different portions of your data, different portions, different segments of your customers with different models. And the second one is you might want to take actions with the models that keep learning continuously. So predict churn and then cross-sell, call, and other stuff that I'll talk about. So that's my plan. So let me talk about the problem first. This is from MIT Technology Review. And during the pandemic, 80% of AI models started not working in deployment. They started not working because the data that they had learned from is not valid anymore. So if you are learning apples and oranges, AI systems will learn and then they will keep working. But if you are in a real business scenario, economy changes, your customer behavior changes, your product, your delivery methods, everything changes. So while everything changes, it's unfair to expect an AI model that has been trained on past data to keep performing well. So businesses know that. For that reason, they train models and then they wait until the model gets worse in performance, and then they train a new model. But doing that, training new models again and again, requires data scientists and lots of programmers. And especially for mid-sized companies, we see that the talent, the data scientist talent, goes to the larger companies. So this is what I found out for United States auto insurance companies. With the top 25 companies, the more the revenue of the company, the more the number of data scientists on LinkedIn within that company. So these guys having less revenue have less number of data scientists, which means they are not going to be able to keep installing new models. So I see machine learning models or GLM models that have not been updated in 2 years, sometimes in 5 years. So and they have been patched up like like a ship that's about to sink, just to make them working. So this is not sustainable, especially for mid-sized companies. They don't have enough data scientists, so they need something that can work continuously without requiring lots of talent. And that's the solution that we offer. The solution that we offer is an agile AI solution, which includes the business user more, because it takes really a village to create an AI solution, not just the data scientist. And the solution is not the data scientist solution, it is the business's solution. So that's why we offer understandable AI, which is fast and easy to deploy, which allows such interactions as you see here, and which is continuous learning. So it is fun, and it also works. And my dream is one day, if I ever retire, for every customer to make some kind of a jewelry out of their model representation. I'll tell you more about that interesting figure on the right-hand side. So the results have been tremendously beautiful. So we have seen, using our kind of AI, we have seen increases in retention up to 10% in 3 months consistently. We have seen cross-sell prediction accuracies rising. We have seen customer call center costs dropping. And these are all direct benefits that the business users can see. So what we have learned from our experiences so far is you really have to show the benefit. Because if you don't, then everything turns into a long project, which people are just tired of. So to include everyone in the picture and to also be able to tackle with change, we decided to have a number of components in our system. One of them is we needed to be always deployment ready. So we have this deployment system, which allows you to have models deployed and also learning and also being explained continuously. We have seen that data health is very important. So to have a successful solution, you need healthy data, you need a healthy machine learning system, and you need a healthy process and business experts, like a healthy process with business experts that can take actions based on AI results. So we provide the data profiler, the Tazi data profiler, which keeps continuously sweeping your data and telling you if something is wrong with it or not. We have a stable, continuously learning system that we worked on for, since 2014, we have been developing it. And we decided to give these interfaces. So the live interface allows everyone to look at the machine learning and business KPIs. The dashboards allow business experts to watch whatever they want to watch and also to deep dive into data. And the insights allows the interactions that I have just shown above to take place and also continuously being able to watch the performance. So I see explanation consisting of actually explanation of an AI model in a working AI model explanation to consist of really 3 parts. One of them is explain me my data. The other one is explain me my model, and then continuously do that. So there are 3 parts that goes with explanation. This is one of our interfaces. We do continuous data validation. This is our profiler. Not only we let you know which features are important if you have enough signal in your data, but we also provide data scientist recommendations so that automatically you have filling up of filling the values that need to be imputed, ignoring unnecessary variables, transformations on your data, creation of new features. So I have many recommendations here, and also warnings, because if there might be leakage in my data. So all of them are provided to either to the junior data scientists or to the data scientists, and sometimes actually our business users, after a while, they're able to actually create models and understand what's happening with these. And if they don't want to, they can just say, yes, I'm accepting these, and they still have a good enough model to start with. And we have seen that start to be very important, because if you take a long time to start, if you wait for the best data set, it will never happen. So whatever you have to start building your model with it and see if you can take any actions in business. This is a decision tree. We use surrogate models, global explanations about our data, about our models, and they are continuously changing explanations. So for example, here in marketing channel, if the customer has not paid for more than 3 terms, and if the customer has transitioned from another company, and if their payment amount is more than $2,406, this customer is going to be churning. So we are able to identify dynamically evolving churn segments through our explanation model. And I know you have questions, so I'll answer them. And what happens is, while your churn, your overall churn is, for example, on over all your data, 87%, and so we found out that it's not enough to say your customers will churn, but you should be able to say, if you take actions on these customers, their value is this much, so you'll be saving $45 million if those customers remain with you, or if you allow, if you are able to get them back, you'll be saving $5 million, for example. So we found out that putting business KPIs on every screen really helps with the business involvement. Then we provide these explanations. We found out that yes, it is important to show which variables your model uses. I mean, without them, business doesn't know what the model uses, what the underlying models use. However, it's not enough. You should also be able to show, again, these patterns and also the ability to interact with the patterns. So as I had shown in the video, the user is able to get deeper into these patterns. They're able to understand what they mean, and they are able to also take actions. So my slide should be here. Yeah. So the user can just click a button and take action. So for example, the user can say, I want to call these people. I want to send a certain message, SMS message to these people in this segment and right now. We also provide local, we also provide tracking of fidelity of explanations, because this model is an explanation model which is on top of all the Tazi models which are learning. Okay, so underneath we have deep learning models, clustering models. We have a bunch of different models working harmoniously to optimize the KPIs. But this guy is trying to approximate it. So you should be keeping track of the discrepancy between the explanation and the reality and the underlying models. So we found this to be very important, and we also found out that it's also important to have sometimes local explanations, because some people think in terms of patterns, rules, and some in terms of weighted averages. So we provide line type explanations, again, the important features and the local explanations in the vicinity of examples that the user is interested in. Explaining, I promised that I would show you how to interact with the explanations, but you also need to be able to update the models. So as a business user, you can understand how machine learning is working, you can take actions, and you can also update the models. So by just pressing this configuration button, you are able to go into the models and you are able to change the complexity. You are able to change the complexity of explanations, for example. You are able to remove some features. You are able to add new features, and you are able to do all of those within the platform. Many users, are able to be at the same time here. We have access, authorization, authentication, tracking of models, the whole thing, which allows you to have a working system in deployment as opposed to just a machine learning experiment. So far, I have talked about explaining and taking actions and also updating the models. We also have the feedback to the models. So for example, here, one of the actions can be you think that this customer segment is a segment where I'm going to be making profits, but guess what? COVID happens, so I don't think this segment will be profitable anymore. So learn this, and you know, the underlying models get that signal and learn from the expert. Again, those can be done, that human in the loop can be done by a business expert without knowing machine learning. Another thing that we see is, you know, when we include business experts in these processes, people first start with, do I have enough data? And then they say, is my AI good enough? And then as soon as they see, you know, some patterns, they start thinking about how to make machine learning better. One of the most obvious interventions is, for example, don't include Porsches in this customer retention model. They are a different world, so put them in a separate model. Or, you know, this region of Greece should be handled by a different model because the behavior of customers are very different there, for example. Or the channel, like the online channel versus agencies, use different models because the behavior is very different. So what we found out is dividing and conquering and creating different models allows business experts to take actions better, as opposed to just having one global model trying to fit everything and trying to explain everything. So that division creates more models, so model management becomes an even more important issue. Another thing that we see is, I'll just go through an example for customer retention. Your sales and marketing and customer experience department is interested in predicting customer retention. So your churn prediction model tells you, okay, you know, who is going to churn, who is not going to churn. And yes, you find out who is going to churn, but what do you do with that information? So instead of just predicting who is going to churn and then taking actions and seeing what will happen, we are able to add downstream models so that you can take actions. For example, for an investment company, maybe your customers will churn because you are taking too much commission out of their transactions. So maybe if you reduce the transaction commission a little bit, those customers will stay with you. So we have price elasticity models, we have cross-sell models, and we have models that can tell your call center how, when, by whom the call should be made to the customer, so that we have different models that allow you to take actions. In addition to taking actions, this example is from actually auto insurance customer retention. When your customer is going to churn, you want to take actions, especially for customers with low risk. You know, here this is price elasticity is a model that you can use for European market. For US market, you can be deciding on whom to call. You can be deciding on different product choices. And then we have the profitability models, which tell you whether you are going to be profiting or not, because profits depend on your costs as a company, your risks, and also the revenue that you are getting from your customer, at least. And of course, you might have other factors that affect your profitability. So you want to find out what is a profitable set of conditions under the situation you have right now. And then, you know, you want to make offers to customers where your customer will be happy and you also will be a profitable company. And of course, if you are not profitable, you can also use the fraud detection models, because fraud doesn't happen like, you know, there is a huge fraud here. Sometimes you are bleeding and you are not realizing it, so you are losing money little by little. So wherever you are not profitable consistently, you can ask either your pricing or, you know, costs, but also you could see if there is fraud or not. So this is our goal at the end. And right now with our customers, we are actually implementing up to 75% of these. So we are about to book a couple of more models. So a number of models, machine learning models, together with business people from different departments, working in an agile fashion, is the way for machine learning to be really useful in finance, in insurance, in retail. So what we see is there is a change happening right now, and we cannot and we should not ask every finance expert, every business, every insurance expert to become data scientists. I'm a data scientist. I cannot become, a credit expert. I cannot become an actuary or an underwriter. I mean, it's just not possible to expect that from me. So we shouldn't expect that from the business experts, but we should give them the right tools and the right environments so that they are able to drive AI and they are able to let it go in the right direction. And if there is noise coming up from the engine, of course, data scientists are there to fix it. So that's all I wanted to say. If you have any questions, I'll try to answer. There might be some difficult questions, but I'll try to answer them.
Great, thank you very much, Zehra. There are many questions that go beyond the context or the time limit, but I will let people ask first. I have my own notes, but let's see who would like to start. It was a very enticing talk, I should say.
Shall I?
Veni, please.
Indeed, it was very inspiring presentation and very vivid. Well, in finance, we say that I'm a classical econometrician, so the argument is that why use econometrics? Do you have such a strong conviction about the model? Why not instead use machine learning? And truly speaking, machine learning it's very in fashion, and we try as academics to publish papers. So we have some blah blah blah. But from the side of the banker, because I work for a commercial bank, and we do a lot of research to advise our clients. It's not the debate about econometrics or machine learning. The question is, does it work? That's the end, because what you want is your client to be pleased, to do a good forecast. So my question is, okay, yes, we deploy, we develop, we do a lot of things. Actually, do they work? Or at the end of the day, because you have 30 years of expertise, you take your own decision? And it's not based on machine learning, but it's based on your instinct and how you understand the needs of the market.
Very good question. And I knew you would be asking difficult questions. So my response for that is, first of all, I mean, I work as a CEO of a startup, right? So if it doesn't work, we are kicked out anyway. So it has to work, and businesses don't really care about whether you used a linear model or a deep learning framework or an econometric model. So my intuition for that, Veni, is the following. I'm showing this. This is by my husband and co-founder. This figure is by him. So when you are living in a more or less stable world, you can just keep learning better and better using the data. But when change happens, if your econometric models or if your experts, their intuitions are able to tell, they are able to tell here, by the way, our continuous learning models will update themselves. as the change happens. And when change happens, you don't actually have lots of data because you think you have terabytes of data, but lots of that data is not valid. So what we recommend is here, your econometric models or your expert can say, you used to go to Tassos, now you should be go to Saloniki, okay? So the expert should tell, the model would go this way, but no, the world will change, so we should be going that way. But the mechanics of how to get there is already there in the model. So the model is able to update itself much faster once it is directed in the right direction. So yes, it works. And if it doesn't work, and I actually, I'm not claiming it works all the time. Okay, so I think we should stop telling industry people that you have a machine learning model and it's like God, it's going to give you answers perfect all the time. No, the machine learning models are actually they are apprentices learning from data and from us as experts, and they will make mistakes. So just like as a manager, we hire people from the greatest institutions and they make mistakes. So how are we expecting a machine learning model that has learned from 2 years of data to not make mistakes? I mean, they are going to make mistakes, but as human beings, multiple eyes will be watching those models and multiple eyes will have ways of correcting them. So I hope that answers your question.
Yes.
So combination, really, it cannot be just data. It has to be data and models and the expert.
Yeah. Thank you very much.
Thank you.
Any more comments? So maybe I will ask a question. I appreciated the fact that you talked about multiple models. And of course, this is a very broad discussion and it might even be a research question. So maybe a comment on how you can exploit more than one model within the same company, within the same application, and whether, I'm sure there is a lot of research there. So how does TASI manage to bring new ideas from research into practice? I don't know if we can combine the two questions.
Yes. So about the models, again, I just want to make sure that when you say model, do you mean I have a customer retention model and I have a neural network decision tree, blah, blah. Do you mean that? Or do you mean I have a customer retention model, cross-sell model, call model, blah, blah. Do you mean that?
No, the first one.
The first
I have
okay,
different, technically different models.
Yes. So in Turkey, we love cats, right? I don't know whether Greek people also love cats. So we have a saying which is called the 9-lived cat. So the continuous learning models have to be like 9-lived cats. You have to just shake them and they should not fail. Mm-hmm. So in order for them to not fail, what we found out is you have to have continuously evolving models, but you should not ever have just one. You should have different types of models. So for example, I find out stacking a decision tree, a Gaussian process regression model, and a neural network together actually is much better than just using an XGBoost or a LightGBM model, for example. So robustness of each model is very important, and also diversity is very important. So each model, those different types of learners will have difficulty with some parts of your data, and the other one will have difficulty with some other part of your data. So what we do is we train different models and we continuously train them so they are updated in time. And we combine them. When we combine, we use really clever combination techniques so that whoever has more strength, we give more importance to that model. Mm. And we also found that simplicity is very important. So we try to keep everything as simple as possible. That's why we have feature selection algorithms embedded in our platform. So by default, we always use feature selection unless you make us include a feature by force. So that's about the combination models. And I'm a believer in ensembles of models. I mean, and diversity, both for humans and for machines. In terms of research, we are involved in 2 EU projects. One of them is the Trust AI project. We are working with these, beautiful researchers who are working on symbolic learning, which is a different type of AI than the traditional AI methods that we are working on. So we are actually bringing in the AI, explainable AI expertise that we got from the field, seeing the customer's needs with the research expertise together all the time in the projects, and also with our consultant academicians that we involve within TASI. We are also involved in another project, ITEA Daytime project, which is about digital twins. And again, there we are using explainable AI for condition monitoring of different medical devices. And we are actually having AI algorithms not just predict if something will go wrong, but also what kind of actions should we be taking so that we can actually benefit from that prediction. So yes, research and applications should be brought together. And I have been in both places. I mean, I have been in academia. I worked at Siemens Corporate Research. I mean, in industry, I have worked in academia. And what I find out is there is this, the lack of dynamism in large corporations and in academia usually as well. But when you're a startup, you have to be like a TASI. You have to keep running. Yes. Because you can be out of energy and game at any moment. So we keep actually bringing the problems from industry and solving it together with our colleagues all the time.
Okay. Perfect.
Thank you.
Thanks. Yes, we have to discuss more, of course.
Yes,
Any
of
other
course,
comment?
I would love to.
Yes. Any short comment before we conclude the session? Okay. So it was a pleasure to see everybody in this session. Daniele, do you have a comment?
I have a very short question, if I can.
Please. Yes. Okay. Yes. Very last one.
Yeah, I mean, it's short question, but I know that the answer is not simple, so I do not want an answer. It's more provocative. But in your opinion, how far are we from a machine learning which is able to choose on itself? I mean, if your business model, if I understand, is just to give advice to people. So fraud detection, there is an advice. This could be a fraud. How far are we to something we say, okay, this is a fraud, let's block everything?
We are so far away from it,
okay.
Daniel.
I agree with you.
We are so far away from it because especially we have been working with banks and also insurance companies in terms of fraud. And what I find out is, you really have to be careful about what you call fraud and what you don't call fraud. So we are very far away. And my hope is to make the lives of special investigation units or customer experience managers or underwriters. My only hope is to understand the steps in their business processes that are repetitive or they cannot see because there are thousands of variables. Just really be their helper. Definitely not. I mean, if somebody tells you that they are going to put an automated machine to detect fraud, your accounts will be blocked all the time and you'll hate to use that bank. So no.
Okay, good. It's interesting. It opens, so you maybe you open up more questions than you close, but this is
we should have another session then.
This is the interesting part. Yeah. Okay. Thanks everybody for speaking in the session and for attending. We have a lunch break depending on where you are. So I'll have my lunch now, and the conference continues in 15 minutes, maybe 13 minutes to be precise. Okay, 2 p.m.
No.
Greek time.
No, it's not 2. It's 2:30. Thank God we have some time.
Okay. Yes. Okay. So 45 minutes from now.
Yeah, yeah.
Okay.
Thank you so much.
Thank you.
Thank you.
Bye-bye.
Thank you so much. Have a great day.
Bye.
Bye.
Yes, we can start. For those who have just joined, welcome. We have a session with the use case and a paper on blockchain. And then there is another session about ESG investing. So there is a slight change. My co-authors and colleagues, Professor Thomas Desaklis and Dr. Malamas, had some urgent issue, and so we have to change my talk with theirs. So we'll start with the paper entitled "A Blockchain Framework for Increased Trust in Green Bond Issuance." It's a joint paper, and I would like Tom to share your screen.
Okay.
Fantastic.
Can you see my screen?
Yes, everything's okay.
Okay, thanks. So good afternoon, everybody. My name is Tom Dasaklis, and with my colleagues Vagelis and Veni, we will be presenting some initial results of a blockchain-enabled architecture we have developed for issuing green bonds. Okay, let me. Okay. Background info regarding blockchain technology. Blockchain technology, I would say, is evolving to be the most significant technology revolution since the invention of the internet. And its adoption is a reality in many fields. As you already know, it was first introduced as the underlying technology of the Bitcoin cryptocurrency, and it was primarily used to safeguard the validity of transactions within untrusted distributed environments. And in principle, a blockchain should be considered as a distributed append-only data structure where non-trusting members can interact with each other in a verifiable manner without the need of a trusted third party. Therefore, blockchain as a data structure is an ordered list of blocks containing and storing transactions in a distributed manner through the usage of consensus mechanisms. Blockchain is resistant to any data modification, so it is in a way immutable, which means that all information registered cannot be altered or modified. And in the literature, there are three types of blockchain networks so far proposed. We have public blockchains, we have private blockchains, and we have consortium blockchains. Two important aspects of the blockchain technology are smart contracts and tokens. Smart contracts with a full Turing complete language provide the ability to perform computations within the blockchain, and therefore we can use them as a decentralized virtual machine. I would say that smart contracts can be considered agreements between mutually distrusting participants, which are automatically enforced by the consensus mechanism of the blockchain without relying on a trusted third party. Tokens, on the other hand, exist to be used with decentralized applications, the so-called DApps. And I would say that tokens facilitate the digital fractional ownership of physical assets. So when developers are creating their tokens, they can actually decide how many units they want to make and where these new tokens will be sent when they are created. And therefore, once created, tokens are often used to activate features of the application they were designed for. And as you can imagine, the ability to deploy tokens at a low cost, relatively and in a relatively easy way on a public infrastructure is a game changer because it makes it economically feasible to represent many types of real life assets in a digital way that might not have been feasible so far. A few words about the consensus mechanisms. Consensus mechanisms are, I would say, fault-tolerant protocols that provide a non-partisan means of establishing agreement on which transactions are legitimate and should be added to the blockchain. Therefore, in a way, the consensus mechanisms ensure that only the true state of the network is maintained. At the same time, they guarantee not only the validity of transactions within a blockchain network, but also the necessary agreement on a network's current state. In the literature, there exists a lot of different consensus mechanisms so far. I would say that among them, proof of work and proof of stake are the most common and are extensively used throughout several blockchain-enabled applications so far. Each mechanism has its own characteristics in terms of speed, computation time, security, scalability, and therefore choosing the appropriate mechanism, the appropriate consensus mechanism, highly depends on the particular blockchain network used, and of course, the nature of the application, of the blockchain application. Nowadays, various blockchain applications and platforms have been developed, and I would say that emerging blockchain applications may be found in many sectors, like, for example, supply chain, in healthcare, in governance, and of course, above all, finance. And I would say that in the next few years, the use of blockchain in finance will likely become common since its intrinsic characteristics make it ideal for financial applications. And such applications include the facilitation of cross-border transactions, the development of trade finance platforms, which obviously lead to less costs, less operational costs, clearing and settlement of financial transactions, and digital identity verification structures, just to name a few. And in the sequence, my colleague Benny will now present to you in more details how blockchain may be used to facilitate asset settlement and post-trade operations with a specific focus on green bonds.
Yes. Can I have the control, Tom?
Yes.
Great. Okay. Let me share again the screen. Just a second. Okay. Just a moment, please. Really sorry for this. Okay, I will share the PPT. Can you see my screen? Okay. Okay, fantastic. Okay. Well, the idea of blockchain, when we use it to issue bonds, we have first to make clear the process using the standard, the classic procedure, and actually what the usage of such a technology will help. So there are some existing inefficiencies in the pre-issuance process, for example. The pre-issuance includes the preparation of issuance, choosing the modalities of the price discovery mechanism, like syndication, auctioning, and private placement, and stripping agreements between the issuer and the investor on the economic terms of the securities. So taking one by one the participants of an issuance, from the standpoint of the dealer, of the bank. Okay, the majority of the practitioners indicate that the manual intensive work is one of the main causes for inefficiencies. Particularly in the underwriting process, a lot of back and forth discussions occur among the lead manager, the issuers, the syndicates, and the investors, as the latter seek to understand the deal structure, the quality, the credit quality, and the industry dynamics. So the communication usually happens via email, Bloomberg chats, informal ways, a lot of times, which means that there is no data room to store documents, and it's very hard to keep the information flow to use it in the future. Furthermore, the lack of standardized information storage practice leads to reconciliation inefficiency. Particularly in bond running process, a salesperson negotiates in private conversations with the prospective investors. Investor then submit a bid via email, fax, phone, Bloomberg chat, whatever. Trading desk accumulates the bids in a spreadsheet, and the information is shared with investors via separate digital channels, resulting in multiple versions of the truth. Since each participant maintains in its own version of the record, of a time-consuming reconciliation process between participating systems will need to be continuously executed to keep everyone in the same status quo. So from the side of the investors, the data referencing is another major pain point. In practice, multiple identifier systems are used, and the process of obtaining security identifiers slows down the speed for trading in the secondary market to some extent. For instance, while there is an amount of securities worldwide assigned with ICEF, the most commonly, which is the most commonly identifier for stocks and bonds in US and Canada, we have QZIP, or in UK, the CDOL. From the sale point, the sale people point, typically distribute deal terms to a static distribution list of clients in order to get the interest from the buy side. And finally, from the standpoint of the issuer, it is pointed out that the unbalanced flow of knowledge results in the situation that information about investors is often of poor quality. So investor identification and classification is needed. Why it's that? Because it's very different. The book of the bond, the interest to be gathered by a hedge fund rather than households or pension funds. So what I described were the inefficiencies, and here you can see the life cycle of the bond. And so what's the idea, since we know how the bond proceeds? Okay. Well, the bond issuance using blockchain really is amazing. It's amazing because we update this table, and truly it's evolutionary. So beginning with the first bond, which is issued by World Bank, we have witnessed more and more pilot projects initiated in order to test or experiment with the performance of blockchain technology in combination with the traditional financing process. So blockchain technology has demonstrated a massive potential to enhance the current outlook. And starting from creation, allocation, and transferring to management, the entire life cycle of blockchain bond takes place on distributed ledgers. I guess that of course, the elimination of the fees is quite interesting and a goal, but what is more a pain point is the settlement. So through the blockchain, what actually we seek is the instant settlement. And that's why the use of smart contracts is a start to achieve the risk from the failure of a trade. Vangelis, would you like to proceed now with the architecture?
Of course.
Yes.
Thank you, Benny.
I'm stop sharing, right?
Okay. Okay, I will.
Or you want to keep it that way and me change the slides, whatever you want.
No, I believe I you see my screen?
Yes.
Okay. So I will focus more on the technical part of our proposed blockchain framework for green bond issuance. Our framework has, we're describing 5 stages in this model. We're starting with the initialization phase, which is the first step where the bond issuer decides bond issuance with the corresponding terms, and then they make the appropriate demand. And then we move to the next phase, which is a preparatory phase, where the validators assess the investment impact in green economy and issue a report. This report is then published on the blockchain, and financial checks are performed by the validators. And then we proceed to the launching phase of the bond. Once the issuer has fulfilled all the requisite documentation, and the regulator has finished all the checks, then the regulator checks the digital bond and enforces compliance with the predefined policy. This step is needed in this architecture because we are talking for a lot of participants with contradicting aims from the system. So it's mandatory to have a validator to validate the procedure and enforce a predefined policy. Then we have the trading phase, when in this phase transactions over the bonds coupons are executed and remain pending on the system until settlement. And validators process the transaction and store the transaction information on the blockchain. In this phase, we have fund transfers for coupon payments and redemptions, which are made in this procedure. And finally, we have the archiving, as Benny mentioned before, which is the final step. All the transaction history is archived on maturity of the bond and on redemption. In this model, we are based on Ethereum platform, and specifically we chose to modify and create a permission blockchain with predefined participants. And for the exchange of the coupons, we're using tokens. In the first phase, when the bond is published on the blockchain, the bond gets tokenized in order to be exchanged in place of coupons. So we have developed 2 smart contracts. One smart contract is responsible to handle all the prerequisites of validators and regulators, and the other smart contract is responsible for the security part of the system, because we of course want to automate the whole procedure of the bond issuance, but without compromising the security. So we have taken this into account. So we created a separate smart contract to implement forensic services. Let's see which are the key players described in our system. The system combines the roles of mandated lead arranger or the passive book runner on the literature, the common literature. So the key players of the system are the issuers, of course, which creates and administers green assets and shares quantitative impact reports using clear metrics. And of course, issuers can also integrate external audits and reviews and publish them on the blockchain. We have, of course, the validators, which are responsible to validate impact reports and are also responsible to deliver the green commitments and the green debt strategies for the bonds published. We have the investors, which can create in the platform investment portfolios and can make investment discoveries and manage assets and monitor assets impact. And of course, we have a very crucial participant, it's the regulator. The regulator oversees the consensus formation, ensuring compliance and regulatory control. The regulator has a strong ability, a veto ability, and is authorized by the participants to stop a block formation when he sees a misbehavior in the system and he believes he should stop the trading. Let's see. This is a high-level figure of our architecture. As you can see in this procedure, the issuer requests a bond issuance from the system, and the system, through the smart contract which is handling the whole procedure, it's the green bond smart contract in the center, automates the procedure to service this request. And then the whole procedure, which we described earlier, takes a form in this system. Let's note that because of the different needs on the bonds, we could use ERC20 tokens, which are identical tokens, or we can use ERC721, which are unique tokens. So if you want to trade something that it's not sliced in identical pieces, you can do this also with different use of the ERC tokens developed in the system. A few words about the security aspect. We have also developed and tested smart contract responsible for the forensics, which keep track of all the transactions made upon a bond trade and the bond issuance procedure. Think of it something like a mechanism for packaging all the information regarding the procedure from the initialization phase to archiving of each bond issuance. This is more or less the framework we developed. It's still, I should say, it's still a work in progress. So there are several things that already are thinking with Benny and Mr. Dasaklis, and we are trying to update the whole procedure. Thank you from me. Benny?
I don't know if there are some questions from the audience. Any questions? Yes. Okay, we have one. Do you think that this is applicable, immediately applicable for banks and other participants? The question comes from a colleague. I think that we all think is, yes, we have a technology, but is it actually easily adoptable, or it is needed a high amount of, for your investment?
If I can say something, and then if you or Tom want to add something, the question is if it is applicable to adapt blockchain bond issuance. So I believe the best answer is one slide you showed earlier, which shows that there are already blockchain solutions for bond issuance that are adopted by big banks and big organizations. So I believe the question is if those mechanisms can evolve into something more efficient, more adaptable, but it's there. It's already there. It's out in the market. So I believe this covers in a way the question. I don't know, Vinny, if you want to add something, or Tom, maybe.
I just wanted to say that also there are some regulatory issues that should be resolved. And as Vangelis mentioned, there are huge corporations or even banks that have ongoing projects regarding bond issuance based on blockchain. So the answer is yes. We think it is applicable, although there are a lot of regulatory issues we should somehow resolve before, let's say, a huge adoption or a large-scale implementation.
And just another question right now. Okay, how quick is the procedure? I guess that the meaning is if you have blockchain, how much do you need to validate a transaction?
Well, that depends on the consensus mechanism used. As Vangelis mentioned, since we have already paid attention to security issues, we believe that using a consensus mechanism, like, for example, the proof of stake, will give us a huge throughput in transactions and therefore increased scalability.
May I add that
yes.
Comparing to the mechanism for bond issuance that are already working, this is a significant step towards efficiency, because we're saying that most of the procedures in the bond issuance are made through the smart contracts with an automated way, which is much faster than the procedures that now exist. So the measurement and the comparison should be made comparing the old procedure to the automated procedure, I believe. So there, of course, there is room for a better architecture, which could, of course, increase efficiency. But I think this is the main goal.
Yes. Okay. Thank you very much. Thank you both.
May I have additional? May I ask an additional question?
Yes, of course.
I'm just wondering if this issuance of bonds on a blockchain is already used. In fact, I could then represent the bond as a smart contract so that it will be executed automatically. Is this also done, or are there thoughts in this direction, something like this?
Excuse me, you mean what exactly? To have access to the actual bond? Or
yeah, I mean, if you issue the bond on a blockchain, then I mean, how is it? If I would like to invest in this bond, to buy this bond, is it similar? So how is it actually happen?
Yeah, in a way it is similar. So it will be a kind of what we call a private blockchain network. It won't be a public blockchain network, like, for example, the Ethereum blockchain infrastructure or the Bitcoin blockchain infrastructure. So it will be a private project within all the interested stakeholders, like bond issuers or banks or investors, you name it. And then all these disparate and different stakeholders will have access to the overall bond issuance process through the blockchain and through the smart contracts.
So those who are participate at this network, who are member of this closed community, can just have access to this bond through a smart contract and invest. So the investment process is in this way also automated.
Yes, exactly. And apart from the investors and the issuer, we will also give access to regulatory authorities, of course.
Okay, okay. So also the trading in the secondary market is also done via this blockchain then.
This is a very, very interesting question. Actually, we would like to, this is an issue we would like also to resolve somehow. The answer is, we don't know so far, but this is an excellent question.
Okay. So this would be a step to be added in a way.
Yes, exactly. Yes. This is a very, very interesting question. Thank you. Yeah, exactly. Thank you very much.
Okay, good. Thank you very much.
Thank you.
Thank you. Okay, thank you both very much. And also we thank Professor Breeman from his comments.
My pleasure.
Yeah. So the next speaker is me. And actually I will present you a use case. Let me share my screen. Okay.
Sorry, are you running behind time, Benny? I thought I was supposed to speak now.
No, but we can change it since I'm the one.
Oh, so
no
I thought. What's the time at the moment?
Then it's 3 o'clock.
Yeah, and I thought I was supposed to speak from 3 to 3:40. Am I wrong?
We are so behind the schedule. Yes, we are. Yes, we are. Really sorry, Professor Edmonds. So we'll skip that one. After all, it's something we will discuss with the regulators in private.
So it's just I've got a meeting at 2 p.m.
Yeah,
at 4 p.m.
No problem. No,
it's
our fault actually. Okay. Just to okay. Yes. So our next speaker is Professor Alex Edmonds. It's a great pleasure to have him here. Professor Edmonds is Professor of Finance at the London School of London Business School, a prolific governance researcher and a super inspiring person. His research interests are corporate finance, behavioral finance, and investing. And some very few of his academic highlights. He has more than 10,000 citations in Google Scholar. His work is published in super top journals like Journal of Finance, Review of Financial Studies, Journal of Financial Economics, American Economic Review, Management Science. His book, Grow the Pie, How Great Companies Deliver Both Purpose and Profit, headed Financial Times Business Books of the month for March 2020, named 2FT Summer Books of 2020, and soon it will be translated into Chinese. And some of his industry highlights, he presented to Board of Directors at World Bank Distinguished Speaker Series. he consulted in person the Netherlands Prime Minister and the Senator Elizabeth Warren on governance. And he was formerly ESG advisor to research affiliates, which runs $200 billion of smart meta strategies. At this point, I would like to ask Professor Valerio Poti to chair the session. Valerio, are you here?
Thank you, Veni.
Yes.
So yes, I think we both struggled, myself and Alex, we both struggled with Zoom link. We couldn't see it. I mean, at least I couldn't see it. No, so thank you for the idea of organizing this session, and thanks for inviting Alex, and thanks for inviting me to moderate the session. I mean, I think your introduction of Alex's work is, was excellent. I wouldn't be able to add anything more. I mean, I just want to highlight, see that just I agree. Sort of. I mean, I do want to. I mean, I want to contribute, sort of highlighting the breadth and depth of Alex's contribution in several domains in corporate finance, corporate governance, and now in this big topic, which is sustainable investing. So without much ado, I would hand over the virtual floor to Alex. Looking forward to his very interesting talk.
Thanks, Valerio. How long do I have? Because we're already starting 15 minutes late, so I just want to make sure that I don't overrun.
Well, my understanding was that we had roughly an hour. Veni, can you confirm that we are still good? Veni, we don't hear you.
We have more than 40 minutes, so you have enough time.
Okay, I thought I was supposed to end at 3:40. So am I supposed to end? That's what it says on the schedule. So do I have 25 minutes or do I have 40 minutes?
No, 40 minutes.
40 minutes, yeah.
Okay, because the schedule says I have to end at 3:40. So the schedule is wrong? Is the schedule wrong? I just want to make sure that I stick to time. So if the schedule's wrong, that's fine, but the schedule says I end at 3:40.
No, it's okay. It's okay. Your talk is from 3 to 3:40. So we have enough time to listen.
Yes.
So basically, I only have 25 minutes then if I haven't ended.
Yeah. Okay. No. Yeah. Sure.
Okay. So I don't have 40 minutes. Okay, that's fine. I just wanted to know how much time I have. Okay. Thank you for the invitation. It's good to be here. Sorry, I just want to make sure that things stick to time because otherwise nothing works. Okay. So what I want to talk about is ESG investing. Does it work and how to do it? I think a good place to start is to talk about, well, what does it mean to be an ESG investor to begin with? Now, often we think of it as avoiding some scandal. And here is one potential scandal, is we saw in 2019 that the Disney CEO made 1,424 times as much as his employees. And an heir to the Disney fortune said that that was insane. Okay, so why people, but actually, if you look at the data, what we found was the Disney CEO actually did well. So Bob Iger was paid $66 million. Now Disney's market value rose by $75 billion in the prior month. So actually, even though he was paid a lot, it seems that he deserved it. And you might think, well, we don't just want to look at the last month, but since Iger became the CEO in 2015, total shareholder return had been 578%, when it had been 140% for S&P 500. So actually, Disney had done a really good job. Shareholders had done well. Also, loads of jobs had been created. So 70,000 new jobs had been created. And also, there were a lot of top quality products being provided, so customers benefited. And so the point of starting with this story is we often think that ESG investing is avoiding outcomes such as excessive pay. We think that the more we give to the CEO, the rest there is for wider society. But in fact, that assumes that the pie is fixed. So it assumes that everything you give to the executive, the blue, is at the expense of investors and stakeholders, which is the orange. So what we need to do is we need to cut the CEO's pay in order to benefit everybody else. So often we think about ESG investing as making sure that the CEO is not being paid too much. But in fact, I don't think that's what ESG investing is about. It's about avoiding the following situation. So let's say you are Kodak and it's 1981 and Sony has released the first ever digital camera. So how do you respond? Now, in fact, Kodak had every opportunity to respond because it actually had invented the digital camera and had a patent for it in 1975. This is what it looks like. It's not as nice as the digital cameras we have right now on our phones, but they had the opportunity to try to fight back. But they didn't bother to do anything about it, right? So their own head of market intelligence predicted that digital would replace film, but it would take about 10 years to do that. So he couldn't be bothered to do anything. And so they just continued to continue with film. And we know how that ended. Kodak ended up being bankrupt in 2012. It lost $31 billion of value for shareholders, and also employees suffered because 145,000 employees were employed at some point. Now, why I highlight these two cases is the first case of Disney having a highly paid CEO was seen as a massive sign of irresponsibility, when in fact Disney had created a lot of value. So society and shareholders benefited. Whereas Kodak, nobody really blames Kodak. The CEO is not blamed for being crooked because he wasn't overpaid. But the fact that he lost out is of no consolation to the investors who lost out and the 145,000 employees who lost out. Okay, so this is really important because we often think about responsibility as being about splitting the pie fairly between executives and shareholders and society, when in fact, what we should focus much more on is growing the pie. We absolutely do want to increase the orange, but the way we do that is not by splitting the pie differently, is not by reducing the blue, it's by making sure that the executives creates value, making sure that we don't get into situations like Kodak. And if indeed investors are better off and make a lot of money, that is fine. Okay, so what I define ESG investing is we want to create profits. Profits and high pay to the CEO are not necessarily a bad thing, as long as they are a byproduct of creating value for society. Okay, so that's the definition, and that's why I wanted to change our way about thinking about ESG. It's not about splitting the pie fairly, but creating a lot of value. Now, the second question is, well, does it actually work? Now, the important thing here is to be careful about confirmation bias. So that is the tendency to accept uncritically something if you'd like it to be true and reject anything that you dislike. And this is a particular issue with confirmation, with responsible business or ESG investing, because we would love to believe that ethical companies do better, even if the evidence is flimsy. So actually last month, there was a study which claimed ESG already paid off. So there was a very famous investor who posted on LinkedIn, is there anyone left on the planet who thinks that sustainable investing requires a sacrifice of return? So he's saying, if you don't believe in ESG, you are not even on this planet, you're an alien. And he sent them, he was sending around this study, and people said, oh, this study's amazing, it's compelling, infallible facts, it's robust proof, when in fact the study was extremely weak. It made the most basic methodological errors. There's another leading CEO who says, be passionate and positive, ignore cynics and skeptics, when in fact, if the evidence says that responsibility doesn't pay off, we can't just be passionate about it, we have to take it really seriously. And so this is something I explored in a TED talk called What to Trust in a Post-Truth World, about how to be really rigorous with evidence. Now, unfortunately, because we started 15 minutes late, I don't have time to go through most of my slides. So let me actually just skip a lot of my slides here just to make sure I end on time. So let me just go to this one about executive pay. Okay, so this explains how we need to be careful with how we do ESG investing. So a lot of investors look at the pay ratio, the ratio of CEO pay to worker pay. And the idea here is that the greater the CEO is paid, then this is something which is just really unfair. And this is based on some supposed research arguing this. So I had to testify in the UK Parliament a few years ago, and the witness before me claimed that firm productivity is negatively correlated with pay disparity between top executive and lower level employees. So the greater the disparity, the lower the performance, because it's demotivating for there to be such inequality. But in fact, what they did is they quoted a half-finished study, when in fact the finished version found completely the opposite. Well, it found that actually higher pay ratios lead to higher performance. Right, so you have a lot of these ESG investors saying, well, let's try and stop pay inequality, when actually pay inequality is linked to better financial performance, not worse financial performance. And so this is why we need to look at the most rigorous evidence. So they had a half-finished study. Once the study was complete and had corrected its mistakes, it found completely the opposite result. So the pay ratio is not the relevant thing. What is relevant, again, I'm having to skip a lot of slides to keep on time, but the most important thing is the long-term nature of pay. So the more that pay is tied to the long term, the better the performance of the company. So this means that it's much more the structure of pay that matters, not the level. I won't have time to go through my papers. Let me go through the second paper here. What they looked at is what happens when shareholders implement long-term compensation within a firm through passing shareholder proposals. And what they found was that profitability goes up. It dips in the short term, but it rebounds in the long term. Innovation goes up, and also various measures of CSR go up. And so that's really striking, because it says that if we want to improve value for wider society, the best way to do that is not to cut the CEO's pay and redistribute it to everybody else, but it is instead to make sure that the CEO is paid according to the long term. And if she is, she will then start to invest in stakeholders. Okay, so that looks at the G of ESG, the governance. Let me now look at the E and the S. So in terms of social, let me look at how a company treats its employees. So this is a study I started around 15 years ago. This is why I really got into ESG. I wanted to look at how well a company treats its employees. So why did I think about employees, not customers or the environment? It's because with employees, they are important for nearly every industry. Right? So whereas the environment, that might matter in transport, but it might not matter, say, in banks, for example. And also what was important about employees is I had a measure which started in 1984, so I had tons of data. And that is really important, right? Because I could make sure that this was something that mattered in all circumstances. If I showed you that ESG outperformed from 2010 to 2019, you might think, well, those 10 years were boom years for the stock market. Right? Maybe ESG only pays off in an upswing. In a downturn like a pandemic, then you need to stick to making money. So because my data source started in 1984, I have things like the financial crisis, like September 11th and so on. And so this is something where I could make sure that it was in the long term, okay? And then not just in bad times. Now, one big problem that we have is it correlation or is it causation? Is it that employee satisfaction leads to better performance, or is it better performance that makes employees happy? Again, I do a lot in the paper to address that. I don't have time to go through this. Instead, let me go through the bottom line. What I found was that the 100 best companies to work for in America delivered stock returns that beat their peers by 2.3 to 3.8% per year over a 28-year period. So this is serious stuff. This means that companies that treat their workers well are not just being fluffy or sort of tree huggy. They're delivering long-term shareholder returns. So this is one of the important cases for ESG investing, is that it actually pays off in the long term. If you look at the right dimensions, the pay ratio is not the right one, but the pay horizon is, and also how you treat your employees is. So my final section is on how to do it. Okay, so what people used to do in the past is they used to engage in ESG investing through screening. Right, they chose certain criteria, and that if you didn't fulfill their criteria, you couldn't be invested in. So if you're an oil company or a tobacco company, or maybe if your pay ratio is too high, or maybe if your board is not diverse, then you'd be kicked out. But ESG was only a foot in the door. Once your foot was in the door, then you could choose the company based on financial criteria. Right, so ESG got you in, but once you were in, you ignored it. You just looked at financial stuff. And there's many problems with that approach. Right, it may well be that it uses the wrong ratio, it uses the wrong measure, like pay ratios. And also it ignores the active value creation. So why I started with the idea of Kodak is a lot of good responsibility is about being innovative. And whether you're developing digital cameras or sticking with film, that is not captured in most of these ESG metrics that I'm mentioning here. So instead, the new approach that many people do is known as ESG integration. So this considers ESG factors alongside financial factors. It considers these things together. Okay. So what we do, so I'm now going to put on my practitioner hat. I serve on the Responsible Investment Committee of Royal London Asset Management. We do what's known as a net benefit test, where we ask, does the company provide a net benefit to society? So it could be that there are some bad things about it, maybe a high pay ratio, or maybe low board diversity. But if there's also a lot of good things about it, maybe this outweighs it. And so this is important because it allows us to take many other things into account. For example, excellence, right? That's not a traditional ESG factor, but it's a key measure of how much value you're creating for society. Are you innovating into something like digital cameras, or are you sticking with film? Another important thing is comparative advantage, right? A company is only responsible if it focuses on what it's good at, right? So in response to things like Mr. Floyd being killed, companies are giving loads of money to charity. But I don't think that's a good thing to do, right? Because if you're doing this, you have no expertise as a company to know which charity is the best charity to give to. Why are they giving to Black Lives Matter rather than to cancer research? But let me give you an example of where comparative advantage is satisfied. So this example is Coca-Cola. So they run something called Project Last Mile. And this is a project which makes sure that medicines are available everywhere in Africa, including the difficult last mile to a rural school or a hospital. And that's why do they do that rather than giving to, say, climate change? Because Coca-Cola's expertise is in transportation. It needs to make sure that Coke is available everywhere in Africa, including the difficult last mile to a rural school or hospital. And you might think, well, why are they distributing medicine? Why don't they distribute books? But the thing with medicine, particularly vaccines, is that they need to be transported cold. And Coca-Cola, being a drinks company, has expertise in refrigerated transportation. Okay, so that's a great way where a company used its own expertise to solve the social problem that was most pertinent to it. Another thing is to consider materiality. So often ESG investing is known as purposeful investing, and people often interpret the word purpose as being all things to all people. So they might say, our purpose is to serve customers, workers, suppliers, the environment, and so on. But actually, if you think about the word purposeful, it means targeted. Right? A purposeful meeting is one with a clear agenda. If I do something on purpose, I'm doing it deliberately. So a purposeful company is one that focuses on a couple of issues. It doesn't try to be all things to all people. For example, Engie, the French energy company, it chose to close down the Hazelwood power plant, right? That was good for the environment, but bad for workers. So if your purpose was to serve both workers and the environment, it's not going to tell you how to make that decision. So I define purpose as why a company exists, who it serves, its reason for being, and the role that it plays in the world. And this is linked to the idea of materiality. So what this means is we need to focus on a couple of stakeholders that are most material to you. So this is my final sections. Right, so this is the materiality map by the Sustainability Accounting Standards Board. Right, and so what this says is that goes industry by industry and highlights which are the material stakeholders in that industry. So for minerals and extractives, obviously the environment is important, but for financials, maybe the environment is not so important. Maybe what matters more is social capital, selling practices and product labeling. We don't want to be like a Wells Fargo fake bank account scandal. And so what this means is, yes, we know that climate change is the order of the day, but if you're a bank, maybe you should focus more on customer privacy and data security. And so the final study that I alluded to, what this does is it takes ESG data from MSCI, which is perhaps the best known data source, and it finds that companies that do well across the board on every stakeholder dimension don't actually beat the market. They only beat the market by 1.5% per year, and that's insignificant. But when they redo this with a materiality lens, and they look at companies that do well on material issues, but they scale back on immaterial ones, they do beat the market by 4.83% per year. So this is really surprising. So what it means is that it's better to do well on only a few things than to do well on everything, right? Because if you're doing well on everything, then maybe you're actually not satisfying your shareholders. Okay, so that's all that I have. I need to make sure I have time for Q&A, but as Veni kindly mentioned, oh, so why is this not advancing anymore? Yeah, as Veni kindly mentioned, I released this book last year called Grow the Pie, How Great Companies Deliver Both Purpose and Profit. And why I wanted to write this book was that just to highlight how ESG investing is something that everybody should take seriously. It's not just for ESG investors, it's for any investor, right? Any investor who just wants to make money, you should be investing in ESG because it's something which is linked to financial returns. But importantly, there are certain factors that matter and certain factors that do not matter. And what I want to do is to use the rigorous research to figure out which is the factors that do matter. Now, unfortunately, a lot of this academic research is written in, as Veni said, the top academic journals, but written in a really boring way. So I wanted to sort of bring it to life with simple frameworks and real life examples to put it into practice. So I hope that that might be a resource to anybody interested in responsible investing. Okay, thank you very much for the attention. Let me hand back. We've got sort of 6 minutes for Q&A.
Many thanks, Alex. Thank you for a very interesting talk. I mean, I'm sure it would have been okay, given the the level of interest in how interesting the talk was. I'm sure it would have been okay if you had taken a few more minutes. But thanks for your effort to finish within the allocated time. I wonder whether there is so that leaves us quite a few minutes for Q&A. I wonder whether there are questions from those in attendance. You can maybe either sort of post some questions in the chat or just directly ask the question. Maybe I can start with one. So I'll give time. I will give people time to either write or prepare to ask their question. So my question sort of is I suppose a rather general one. I guess there is an information asymmetry problem, right, between some stakeholders and and management, executives, the senior management. So in other words, if some stakeholders do not appreciate that disparity in pay, okay, is not bad per se, it's because they can't perceive, right, the value that some individuals with the right skills, with the right knowledge, with the right incentive to take risk, with the right long-term horizon, okay, the value that they can generate. So how do you propose to solve this sort of is there a way forward out of this information asymmetry problem? And I mean, I see in sort of is the premium that the focused companies that you mentioned at the end, right? The companies that do focus on some dimension, right? There is a premium sort of that they generate. There is an excess return that they generate. Could that be seen perhaps as a manifestation of this information asymmetry, even at the level of the market, at the level of the investors who don't see, in full the value that commitment focused commitment to ESG can generate?
Well, so I think that there's sort of different questions in what you're saying. So the first one is what the value of the CEO is. I think this is why I think academic research is really useful. They're trying to find out what is the contribution of the CEO to a company. So if a company does well, how do you know whether it's the CEO? Well, it could just be employees, it could be luck. And so there's some very good research which shows that it is actually the CEO who is responsible for a reasonable amount of it. Obviously not for everything, but a decent amount. So that's within chapter 5 of the book. So I think it's important to recognize the value placed, so the value created by these people. And I know it's a bit uncomfortable, right? People like to think, well, the CEO is just like another person, but people are willing to accept that, like, footballers should be paid a lot. They can see them score goals. We can see sort of musicians, right? They they make tons of money. I play in the band at my church. My church is the second largest church in London, so all the singers are amazing quality. You would not be able to tell the difference, I think, in terms of their ability in singing with a pop star, but they get paid far less. Again, we sort of we are willing to believe in some areas that people are skilled, even if they're not. So for some reason, just because what the CEO does is sort of behind the scenes, and we like CEOs to be humble and not take the credit for themselves. But I think this is bad. And I think it's also the media has part to play with this. The media was the one that sort of got really angry with Bob Iger's pay, when actually he deserved it because of the value that had been created. So I think it's to look at the value, just to be willing to accept, yeah, there are some good people who create more value than us, and they'll create more value than me, and I don't begrudge their pay. But that's one thing that the book wanted to try and highlight, is there is evidence showing that CEOs do create a lot of value, even though we'd like to think.
Can I come in just 1 second on this? Actually, there is one paradox, if I may add one more paradox. I mean, when you think about it, very often the public and the media, right, seem to be happy with the money that shareholders make, right? So they think, okay, the shareholder is taking risk, whereas the CEO is not taking any risk, without thinking that, okay, there is somebody who has invested a lifetime to generate the skills, okay, with which is generating the value that in some cases is generated. So that's the further paradox I want to. People seem to understand the value that is generated by entrepreneurs. Yeah. But not by managers.
Yeah, I think it's a big paradox. So clearly entrepreneurs are slightly different from CEOs because they started the business, but to see one as being completely amazing and the other as just being sort of some sort of hired person is unfair. So indeed, some CEOs are entrepreneurial, right? So if you were somebody, the CEO of Kodak, and you launched digital cameras, that's entrepreneurial. Right now in the pandemic, if you're a Mercedes and you're launching CPAP breathing machines, which are a less invasive alternative to ventilators, that is entrepreneurial. And so I think this and CEOs are taking a lot of risk, right? If you underperform, you are fired, right? The actual CEO tenures are getting shorter and shorter now. So the idea that CEOs don't take risk, I don't think it is the case. And I do think the perception should be different.
Thanks, Alex. Is there any more question? Any other question from the floor?
Yeah.
From the audience, please. Peter, hi.
Thank you. I would have a question. So what do you think about the EU taxonomy on sustainable finance? Is this addressing some of your points?
I think it's somewhat problematic because this just tries to look at quantitative measures of responsibility. So I know that people like to look at things like carbon emissions and so on. Obviously that matters, but I'm now putting my Royal London hat on. We ran our portfolio through the MSCI warming tool, and we found that the worst performers were semiconductor companies, because when you make semiconductors, you release something called perfluorocarbons, which actually are even worse than carbon in terms of trapping heat, when in fact semiconductors could well power the solutions to climate change. So these taxonomies like the EU, it's very well sort of intentioned, but it can only ever focus on measurable dimensions of responsibility like carbon emissions rather than the value created by your products. Similarly, so let's say we care about employment, it can measure things like your pay, but not meaningful work and skills development. Like Henry Ford famously paid people $5 a day, which was a lot of money back in the day, but gave them the most boring, routine and repetitive jobs. So I think that's a bit of, so I think having data and measurement is useful, but when people sort of get too focused on them, that's a problem. So it's not just the EU Sustainable Finance Directive, it's also the World Economic Forum has come up with this set of sustainability metrics. And if you can always focus on the metrics, but miss the point. I can focus on providing high wages and not these other forms of value to employees. Now there's this big move towards let's link CEO pay to these ESG metrics. And they're saying, well, anything important that a company cares about, you must link the person's pay to it. That's ridiculous, right? Doctors, it's important that people don't die, but you don't link doctors' pay to patient survival rates. And for teachers, that's a really important job. You don't pay teachers according to test scores because otherwise they're going to be teaching to the test. So I think there is a danger that some of these directives are trying to regulate CEO, ESG performance, when in fact my approach is to say, well, it's in your interest. It's good business for you to develop these ESG factors, because with regulation, you can always just do the minimum possible to comply with the regulation.
Thanks, Alex. I'd say there is maybe time for another question, right? If we want to stick, sort of religiously to the schedule.
Yes, just it's a question from the audience. If we trust the data providers about the ESG scoring.
Well, it depends what you mean by trust. So people are upset with the fact that there is a disparity between different ESG rating agencies, right? So if you were to take Thomson Reuters and MSCI, there's not going to be a high correlation. And so people means that says that, well, that's untrustworthy. But I don't think that actually means they're untrustworthy. They simply disagree, right? So with equity research reports, one equity analyst will say this is a buy and another will say this is a sell. This doesn't mean that they're wrong, that anyone's wrong. They could just have different opinions. So I think if we realize what an ESG rating is, it's an opinion on ESG, and people's opinions might be different. So I might care more about employment and you might care more about the environment, and we can put different ratings. So I don't actually think it's a problem that these things disagree. You should need to just understand, well, what are they focusing on?
Okay.
Yeah. And if there is another question, may I quickly ask one, which goes to the art? If I think we have a couple more minutes.
This is not about religiously following the schedule. We're actually 1 hour behind, Valerio. So that we haven't even done the 2 p.m. or the 2:30 p.m.
Okay,
slots.
so I think
that's why I wanted to. Yeah.
Okay, thanks. Yeah, no, because the different time zones are somewhat confusing. Anyway, so my question is the following, right? I find that the point you raised about the sort of the complexity, about that is involved in measuring ESG performance, I found it very compelling, right? So, and the interesting thing is that we don't just have a measurability, an observability problem. We have a problem in the sense that there are trade-offs. So any measure, okay, that we use, we'll have to, in some sense, understand the trade-offs, right? Or take the trade-offs into account. So for example, like, the company you mentioned, sort of with semiconductors, you may be part of the problem and part of the solution, right? So do you see any possibility of using for example, artificial intelligence algorithms, okay, to produce complex, intelligent, in some sense, measures of ESG performance, measures that intrinsically trade off, maybe using stochastic dominance, things like that, should intrinsically trade off?
Well, there is an organization trying to do this, right? And that is Arabesque. So they're using artificial intelligence to come up with measures. And there is some value to it, but Arabesque? I still don't think it's going to be perfect. Why? And their product is called S-Ray. I'm going to type it into the chat, because like there are always going to be dimensions which are not going to be quantifiable. So let's say we want to hire somebody for our company. Right. Yes, you can scrape all the data on social media and you can do personality tests and so on, but you'll still need to meet the person and interview them. So I think there's still, while there will all, yes, you can get sort of better and better data, but there's still certain aspects which will always be qualitative. So this is not to say we shouldn't try, but I say that we don't want to put too much weight on the data because there will be certain things which will not be measurable.
Thank you. Thanks, Alex.
Great. Well, thank you so much for the invitation. It's great to be here, and thank you for your interest in my work.
Yes, many thanks. Yeah, thanks. Very much appreciated the talk you gave. That sort of the introduction to your book. Thank you on behalf of all of the conference and all the attendants. Thanks, Alex.
Thank you.
Thank you very much all for attending. I would like to close with an announcement for our final day of the conference. Here we are. The final day of the conference will be on April 12th, and our keynote speakers are Mike Jonas from Lancaster University and Christian Brownlees. Also, I would like to say that it will be a joint organization with Athena, and my special thanks to Yannis Emiris, who is a member of our Cost Action, and he's also in Action, and I thank him very much for that. Not only him, but his team. My special thanks to Hellenic Capital Market Commission, Cyprus Exchange Commission, Bank of Greece, to the participants one by one, Valerio Poti and Peter Schneider for being also a part of this organization, and I'm looking forward to see you. Thanks again. Have a nice day. Have a nice weekend. See you all. Bye-bye. Bye.
Bye, Veni. Thank you.
Bye. Bye-bye.
Bye.